Hello everyone, Radhe Radhe. Today I will be revising accounting and reporting of financial instruments. Okay, this chapter covers 3 IND AS 32, 109 and 107. This chapter is most important from exam point of view because it comes for at least 20 marks and it's the easiest chapter if you study it properly. We have already completed this chapter. We have also done the questions of it. So today I am going to revise all the concepts for you again. So first of all, let's talk about financial instruments and which accounting you will see here and what are financial instruments. So in brief, the investments you make, like any company's equity shares, debentures, preference shares, you invest in all these, okay, and how will you account for your debtors? IND AS will tell you all this. I'm a company, I took money from debentures and preference shares. This IND AS tells you the accounting of all these. So these all are your financial instruments which we will understand in detail now. So here you have 3 IND AS 32, 109 and 107. So IND AS 32 will tell you all the definitions. That what are financial instruments, IND AS 32 gives all these definitions. IND AS 109 deals with accounting of financial instruments and IND AS 107 explains what notes of disclosures should be made in the financial statements. So IND AS 109 is most important because it has the accounting in it. That's why it is majorly known as IND AS 109. We are going to read all these 3 IND AS together to understand this chapter. So you don't need to separate this financial instruments chapter IND AS wise. So first, let's understand what financial instruments are. So the meaning of a financial instrument is a contract that creates a financial asset in books of at least one entity. And in the books of second entity creates a financial liability or equity instrument. In one's books, financial asset, in second's book, either liability, that too financial or equity instrument. You might think what it means. So I will be explaining it through an example. Look here. Suppose there is an entity A Limited. So A Limited sold to someone. Now if I sold it to someone and if I will be receiving money from him, then he's my debtor. Suppose the one I sold to is B Limited. So that debtor is my financial asset. So I sold it to B Limited, so a debtor is created in my books. And if you think from the point of B Limited, they purchased from me. When I sold the goods, they purchased it, right? So after purchasing, what entry he would have passed? Purchased to A Limited. So in his books, I would be showing as a creditor. So what happened here? A creditor came into their books, a liability came, and creditor is a financial liability. We'll see what is financial asset or financial liability definition wise. I just want to explain it. That one item, one contract which resulted in an asset being created in one entity's books and a liability being created in the other's books. And such contracts are called financial instruments where an asset is created in the books of one entity which is a financial asset. And the liability created in the books of the second entity is financial liability. So such contract is called financial instrument. So this IND AS tells you the accounting of this particular item. See the next example now. I gave a loan to an entity B Limited. I gave a loan to B Limited, so for me it's an asset because I will get money in future, so it's an asset for me. And what about B Limited? What about them? B Limited took a loan from me, so they have a liability. And this giving or taking loan is a financial asset or a financial liability. For me it's a financial asset and for the other it's a financial liability. This is also a contract of financial instruments. After this, let's say the company B Limited issued its debentures in the market. So I invested money in their debentures. So for me, what is it? Asset. This is my financial asset, and the money that B Limited raised through debenture is a liability. It is a financial liability. Let's take another example. B Limited company issued its equity shares in the market. I invested in those equity shares. So what are those for me? Financial asset. I am investing in its equity shares, so it's a financial asset for me. But tell me this time, what did B Limited do? They issued equity shares. Now is issuing equity shares a liability? No. Equity shares are equity shares in itself. That is the equity share capital of the company. So the equity share capital of the company B Limited would be referred to as the equity instrument. Now what will B Limited call equity share capital? Equity instrument. Now in IND AS language, equity share capital in technical language is called equity instrument. Okay. So means this was a contract where a financial asset is created in one entity's books when I invested in the equity shares of the other party. So for me it was a financial asset. But what was created for the other entity? It was an equity instrument. It was not a financial liability for them, but an equity instrument. Means a contract because of which a financial asset is created in the books of one entity. But in the books of the other entity, either a financial liability or an equity instrument will be created. I've explained this to you with an example. Let's see what more is there. Now we need to understand what is financial asset. I've written down some points in the definition of financial asset. You have to keep in mind these 5-6 items that I have noted down. These will always be asked in financial assets. First one is cash and bank balance. The cash and bank balance in your books is your financial asset. After this, equity instruments of any other entity. I have done investment in the equity instruments of any company. Means if I've invested in any company's equity shares, those are also financial assets for me. See, I said equity instruments. In technical language of India's equity shares are called equity instruments, right? So for me, what are equity instruments of another entity? Financial assets. If I invest in the equity shares of a company, then for me it is a financial asset. Now see the third point here I have written is contractual right to receive cash. Any asset where I have a right to receive the cash due to a contract, that is also my financial asset. I have written down the example of this debtor. I sold to someone, so I made a contract to sell it, so here a debtor arised. What is debtor? I have the right due to the contract that I will receive cash. Cash does not mean only currency notes. Cash can be money from the bank or not. Money should be received or a transaction will be received. After that, bills receivable, investment in debentures of any entity, investment in preference shares of any entity, and loan given, etc. I invested in a company's debenture, so what will I get, sir? Interest. And principal amount, same way if I invest in preference shares, I'll get dividend, also the principal amount. I gave someone a loan, so I'll get interest on that loan along with principal amount. So this all is financial asset for me because I have a contractual right to receive cash. The fourth point is contractual right to receive equity instruments from any other entity. Now there is a contract, and due to this contract, I have received the right to have the equity instruments of another company. Another company is what? Equity instruments. Okay. Sir, what does it mean by equity instruments of another company? So it means I have got the right to receive the equity shares of another company in one of the contract. When do we get it? Suppose the other company has issued debentures, but those debentures are convertible. So if I invest in those convertible debentures, what does it mean? Convertible debentures means those debentures that will convert into equity shares after a period of time. So if I make investment in such convertible debentures, then what will I get in future in return for these debentures? I will get equity shares of that company. So this is one of the kind of a contract in which I have received the right to have the equity instrument of any other entity. All right. Equity instrument means equity shares of any other entity. This is also a financial asset for me. And last is derivative contracts, which are potentially favorable for the entity. Now what is this? Look, derivative contracts you learn in SFM, and rest I already told you. Okay. Derivative contracts are contracts which are a kind of betting in nature. Let's say where you have to gamble. So suppose today share of Reliance is rupees 2000 and I have made a bet that the share of Reliance will increase by 2000 in the next 3 months. Bet is the price will increase. In the next 3 months the price will go up. Suppose a balance sheet date came in within the 3 months, and on this date Reliance share price in the market went to 2100. It's like I was betting price would go up from 2000 and now it is 2100. Means price increased by 100 rupees. So currently I'm winning the bet and the other person is losing. So in this betting, I think I will get some benefit. It seems to me, because today I'm happy the price has gone up, but I'm praying to God, I hope this price remains stable in the market. So the price increase is favorable. It seems beneficial for me, or we can say potentially favorable. No profit today, but profit will be there on maturity. But today I can see there will be a benefit. That means it's potentially favorable. So any derivative contract that is potentially favorable for me, I would call it my financial asset, because if it is favorable to me means it is my asset. And where did this favorable come from? A derivative contract means it is my financial asset. This is something you need to remember. There are 5 items that are in your financial assets. If I summarize, you have to remember if you have invested in any companies, equity shares, preference shares, debentures and all, or if you have any debtors. This is your financial asset. Just remember this in a summarized way. After this, what is financial liability now? In financial liability, I have written 4 components. Keep these 4 components in mind. It's the contractual obligation to deliver cash. First of all, I have a contractual obligation to give cash to anyone. I have obligation on my part to give cash to anyone. Which obligation? There should be an obligation arise from a contract. An example of this is creditors. What is that? Suppose I purchased goods, and if after buying goods I have to give money, then it's a financial liability. After that, BP, bills payable. Redeemable debentures issued by an entity, or redeemable preference shares issued by an entity or loan taker. Let's say I issued debentures. The debentures issued are redeemable, means I will have to redeem them in cash in future. I will need to pay interest. Means my financial liability is obligation to pay cash. I have issued redeemable preference shares, which means I have taken money today, so in future I'll have to make a repayment of principal interest, which means this is a financial liability for me. I have taken money on loan. I have taken money on loan. So sir, I will have to pay interest on principal. So this is a financial liability for me. So the first point was contractual obligation to deliver cash, and the second point is contractual obligation to deliver other financial assets. There is an obligation on my part in the contract to give any other financial asset of mine. Giving cash is not an obligation. It's just other financial assets. So cash is also my financial asset, right? Means in any contract, if I'm talking about giving a financial asset, it means that it's a financial liability for me. If I'm talking about paying cash, so it is a financial liability or any other financial asset here, then also financial liability. Should we take an example? Yes, but it's not useful from exam point of view. Anyways, understand it. Suppose I purchased some items, some goods from a particular person for 10 lakhs. So in my books, it will show creditors of 10 lakhs rupees. But do you know what I told this person? That look, I don't have money, I don't have any cash to pay. So what will I do here? I have Reliance Company's debentures. I have invested money in some debentures of Reliance Company. I will transfer those debentures to you. I have told you there are some debentures like this. I'll transfer those to you. So guys, look at my books and try remembering traditional balance sheet. On this side I have assets. So in asset there is investment in debentures of Reliance Limited is what I am seeing here. So investment in debentures is basically financial asset for me. I told the creditor who is in liability. I told him that I will give him my asset. Which one? Financial assets to settle this liability. Means this liability, what kind of liability this is? Financial liability, because it has a contractual obligation to deliver financial asset. After this derivative contract, which are potentially unfavorable for the entity, I had given an example. I just placed a bet with a person for Reliance shares. That if Reliance share price increases from 2000 in 3 months, I will win, and if the price falls, then you will win. So just before 3 months completion, a balance sheet date came, and on that day, the price of Reliance shares in the market went to 2100. So for me, what was it? It was potentially favorable. Potentially favorable for me, I saw an advantage for me. But think what the person in front of you might think. He must be thinking the price has increased, I'll be in loss, and must be praying for the prices to come down. So right now there is a potential loss to him, 2000 to 2100, the price increased by 100 rupees. So he has a loss of 100 potentially. This is looking unfavorable to him. So if there is a derivative contract which is potentially unfavorable for him, he will say I have a derivative financial liability. He'll say I have a derivative contract liability, a liability in the derivative contract. That means if a derivative contract is potentially unfavorable, then it becomes your financial liability. After this, I have written another point here, contract to issue variable number of equity shares. I did a contract with someone. What kind of contract? Suppose let us take the same example, like I purchased goods and creditors raised in my books is for 10 lakhs rupees. So now what I told this creditor is that I don't have the money with me. I don't have money to pay right now. Here understand the situation. Here I have to pay that person. So what I do for that, the payment due date will come after 3 months. Suppose I had to pay after 3 months. So what I said, 3 months later, I will give you all the equity shares equivalent to 10 lakh rupees. Okay. I will issue equity shares of my company worth 10 lakh rupees. Why worth 10 lakh rupees? Because I have bought goods worth 10 lakh rupees today. Okay. And I said after 3 months, how will I make the payment? After 3 months, I will issue that much equity shares from my company that will have a value of 10 lakhs. So this is also a financial liability for me. What it is? A financial liability on me. Contract to issue a variable number of equity shares. Contract to issue variable number of equity shares. I haven't issued any equity shares yet. I will do it in future. How many? I haven't fixed the number of shares yet. After 3 months, I will issue shares according to the market price of the equity shares, so that he gets the shares value equal to 10 lakh rupees. What's the reason? Let me tell you equity instruments first, then I'll give you the reason. Now look at the third item, equity instruments. What's the meaning of this? See, the definition of equity instruments is just one thing in a line, which has a residual interest in net assets of the entity. Example, entities on equity shares. So such items that have a residual interest in the entity's net assets are known as equity instruments. I will tell you that this IND AS of financial instruments only gives a small definition of equity instruments, and it won't talk about the accounting of equity instruments. Equity instrument, generally what did I say? My equity shares, I'm a company, and if I raise money through equity shares, I would say I raised money through equity instruments. If I raised money through equity shares through market and raising money from there, then I raised money through equity instruments. What is the general meaning of equity instruments? My equity share capital, my own equity share capital is my equity instrument. We are not going to learn accounting for any equity instruments here. How is accounting of equity share capital done? It is the same thing that you have been learning since 11th, 12th class. You raised the money, face value goes in share capital and rest of securities becomes premium. And AS will not teach you this in accounting. So what are equity instruments? Generally those items whose residual interest, remaining interest remains in the business is called equity instruments. We will look more in details in IND AS, but keep this in mind for now. After that, I wrote contract to issue fixed number of equity shares. I said to somebody, suppose he was my creditor, a creditor worth 10 lakh rupees. I told this creditor this time, you know what I said? I told this creditor that I won't pay him cash in 3 months, but I will issue 1000 equity shares of my company. I will issue to you 1000 shares of my company's equity at whatever price they are in the market. Maybe one share is worth 10,000 rupees or can be of 10 rupees. I will issue 1000 shares. Do you agree? The creditor agreed. He said, it's okay, no problem, just issue 1000 shares. So I made this contract with the other party to issue a fixed number of equity shares to them. This contract that this creditor is coming in my books, what will this creditor be? This creditor is an equity instrument. Means if you are talking about the era of AS. So sir, in the era of AS, you used to call your creditor as your liability. But this time this creditor will not show in my liability. It will be shown at equity head, equity instrument. If I show you the balance sheet of the IND AS, then according to that you will understand better, which I have explained in the lecture also. Look at the schedule 3 balance sheet once. See schedule 3, which is division 2 according to IND AS. In this first you have assets in the balance sheet. First of all comes the assets. In this we saw some assets are there. Whose IND AS I mentioned, like PPA IND AS 16, where we learn accounting. Investment property in IND AS 40, intangible assets in IND AS 38. After that there is a category called financial assets. So here you will see only 3 items under financial assets. They are investment, trade receivables and loan. So I told you investment like equity shares, preference shares, debentures, etc. All of them are financial assets for me. My debtors are financial assets for me. If I have given a loan to someone, it is a financial asset. After that, if I come to current assets, so here in financial assets, you will see investment, trade receivables and loans. Apart from that, cash and bank are also there. Cash and bank are also a financial asset. If I go into more detail with you here in the revision video, what you used to do is that you would classify the balance sheet into current and non-current. You would do it for 12 months and more than 12 months, right? The balance sheet has current and non-current assets. There is a sub-classification also, financial assets and financial liabilities. The rest are all non-financial assets or non-financial liabilities. Okay, keep that in mind. We started classifying some particular groups of assets as financial assets. We started classifying some particular groups of liabilities as financial liabilities. Once you total the assets, your liability section begins. The first item that comes under the head of equity and liability is equity from the perspective of the IND AS. If we talk about the era of AS, the format of schedule 3 division 1 that was there. The first thing in equity and liabilities was shareholder funds, which include share capital, where both preference share capital and equity share capital were shown. But in IND AS, what comes under the equity head? In equity head, first comes is equity share capital and then other equities. So what's happening here? See this equity head, it's handling all the equity instruments. Equity instruments, this equity head, we are calling it as equity instruments in a way, understand this. What is coming this side? The equity share capital. Understand from its name itself, only the original equity share capital of the company will come under this. So where does this preference share capital come? Put the rest of the things in other equity. Okay, other equity. I had mentioned this once in the starting lecture also, that the other equity includes all your reserves and surplus and many other things. Okay. So all the other items that are related to the equity equipment will be included in this. Because I am assuming that you have already read this chapter once, as this is a revision video. So here your liabilities start. Here also if you look, you see financial liabilities including borrowings, lease liabilities, trade payable, all of that comes under it. Okay, so basically the head of these equity instruments, these are your equity instruments. This is the head of the equity. Two things in equity, one is equity share capital and the other is other equity. Equity share capital is the company's equity instrument and other is reserve and surplus. What is reserves and surplus? It's company's earnings. So who has the right on company's earnings? Company's owner. Who are the owners? Equity shareholders, which means the portion of the company's earnings is also an equity instrument. Other equities are also equity instruments. Okay, if I have to explain from the definition, those people who have residual interest are equity instruments. Tell me in the company how residual interest comes. If I say that the company winds up, then all the assets of the company will be sold. What will happen after selling all the assets? First of all, the people who have liabilities will be paid. If the company has any money left, it will go to these people, the equity holders. So equity instruments are those people who receive the residual interest in the company. Okay. Is it clear? Let's see now. So those who have equity instruments, residual interest means your equity share capital. After that, I have entered a contract to issue a fixed number of shares, which I will issue you in the future. So you will show that particular item in equity. Now see, I told the creditor that you will be given 1000 shares of my company after 3 months and your liability will be settled. So where to show this creditor worth 10 lakh rupees? These are equity instruments by nature. So it won't come under liability. Where will it come? It will come under the equity head here. So where do we show it in equity? In equity share capital? No, don't show it there. Today we are not giving any equity share capital. We'll give them a fixed number of shares. We will show it in the other equity which was there in the equity head. And there are many things in other equity. And just like this, if I had told the creditor that I would issue him shares which will be equivalent to 10 lakh, I did not say a fixed number of shares. Instead, I said a variable number of shares. Issue whatever earned after 3 months, meaning contract to issue variable number of shares. So I'm going to issue equity shares of my own company. How much I will issue in the future, I haven't fixed yet. It will be equal to 10 lakh rupees. So it means I'm using those shares as a currency. I'm using them for making payments. I won't have cash, so I'll be issuing equity shares worth 10 lakh rupees. Then it becomes financial liability, then creditors will come in financial liability. Is that clear? Now let's move on. I have written a note here. If you have any statutory right or statutory obligation to receive or pay cash, it is not a financial asset or a financial liability. Okay. For financial assets, there should be contractual rights to receive cash. For financial liabilities, there should be contractual obligations to pay cash. What does the statutory right mean? This statutory obligation, that means it's a right or obligation that doesn't come from a contract but from an act or a statute. Like the Income Tax Act states that if a person earns this much income, then he has to pay this much income tax. So in my books, the income tax payable is 10 lakh rupees. Why do we have to pay tax of 10 lakhs rupees income? Because of Income Tax Act. So here liability that I have, that is income tax payable. You can also say here it is an obligation to pay cash, which is absolutely true, but not a contractual obligation. I have not entered into any contract with the income tax department. I have to give money only because of Income Tax Act. So this isn't my financial liability. So any income tax refund asset you're getting, that's not financial asset. After this, the second note, this note is very important. Pay attention. I am an entity, I issued any preference share, or I issued a debenture, or I took money on loan. So what I am trying to say is that I have taken a loan by borrowing. I am an entity, I have taken money by borrowing. Okay. So the entity has to classify this borrowing as a financial liability or an equity instrument. If you have taken money on loan, it's a liability, right? When did it become equity? Now, if you think that your creditor can move from liability to an equity instrument, then borrowing can move too. But for that, there will be some conditions that you need to check. Because this IND AS runs on the substance, it will make you talk about the whole substance. So I took out a loan, just speaking from the perspective of the entity that took loan on borrowing. Whoever has invested, if I'm an investor and I have invested in some company's debentures on preference shares, then for me, it is a financial asset. If you think of a traditional balance sheet, the asset part has nothing to think about, but if it becomes a liability for me, it will either be a financial liability or equity instrument. I just need to classify it there according to the definition. Should it go under the head of financial liability or the head of equity instrument? Where to classify it? So suppose I raise money through a debenture or a preference share loan, then you need to see it on basis of its feature, that what features it has. We will have to classify it based on its features, on the basis of its substance, to see what kind of features it has. Suppose I have taken money from someone, the interest I have to pay on it. I mean, if I have taken money on loan or debentures, so the interest I have to pay. If money is raised from preference shares, then whatever dividend is to be paid. So whatever expenses I have, whether it's interest or dividend, if it's mandatory, then it's of financial liability nature. Because tell me where the mandatory interest comes from when I take money on loan. If you think about it, if I talk about raising money from debentures once, then the first thing that comes to your mind is, sir, we will have to pay some interest. If I took a loan, so first thing comes to mind is that I will have to pay interest. So when you have to pay mandatory interest, which means it's an obligation to pay cash for me. So in this case, this is a financial liability in nature. But you know what I told those people from whom I raised money through debentures? I said, look guys, please give me money, I'm raising debentures. But in exchange of it, I will give interest only if I want. I can give less interest or more interest. It's all up to my will. You guys can never force me. They said, no problem. We agree. Your company is very big. If we invest in your name, we will earn on the market price. You just take money. So they agreed. Now I am not mandated to pay interest on these debentures. I will if I want to. And even then I will be giving it as per my wish. So tell me what feature is inside it. We remember such feature, but it's not in the debentures. Sir, such a feature is there in equity shares. If I raise money from equity shares, then the other party doesn't even think that there will be any income. He is not expecting anything like whether the company will give dividends or not, and if it does, how much. Because it is company's decision to pay dividends or not on equity shares or how much. It's all the company's decision. So when I raised money from the debentures, I told them that I would give interest if I wanted to, otherwise I wouldn't give it. And also it's up to me how much I give. So here I have added the feature of equity, okay. This debenture is just the name, this piece of paper that I have written the debenture on. It's just the name on it, while it has the qualities of equity. Classify it on the basis of its quality and put it in equity instrument and don't call it liability. Or financial liability, it will talk a lot about substance like this. If money is raised through preference shares, so you should look at its features. After this, the second feature which you need to check is that that particular instrument is redeemable or irredeemable. Suppose I raised money from debentures and I said I will redeem it in 5 years in cash. Redeeming means I will give you the principal amount in cash and close it. So this is my normal obligation to deliver cash, means financial liability. That's what happened in debentures and preference shares. But if I took money from the debenture and told the people that, look, give me the money, but this money and this debenture will never be redeemed. It will last a lifetime. It is irredeemable. It is perpetual. So what feature is this? Tell me if there's such a feature in any loan. You get a loan from the bank and tell the bank that the money you gave me, you won't get it back. You can't say that unless you're Vijay Mallya. Okay, Vijay Mallya is a different story. The rest of them are just poor souls who will repay the banks. If the bank wants to recover its money, it knows how to do it. Okay, so whenever we take it, we know it will be redeemed, so it is a liability for me. But when I took money from the debenture holder or raised money from a loan, what did I tell the other party? I will never pay this money back in my lifetime. This is irredeemable. So whose feature is this? This is a feature of equity holders. This is a feature of equity share capital. When I raise money from equity share capital, okay. So when I raise money from equity share capital, the other party doesn't expect to ever redeem it. Once the money is invested in the company, it is invested. When the company closes, then the equity holders get the money. Otherwise, now any student would use too much of their brains and say, sir, there is buyback also. So that's an exceptional situation. Don't bring up exceptional situations, as it will become a different condition then. Okay, think normally. So equity shareholders are never given back the money. They are never redeemed. Sir, when I issued debentures, I said they are irredeemable. So this has an equity feature. Classify this as an equity instrument. So if I raise money through my preference shares and it is said that it's irredeemable, then it will go up in equity instruments. So after going to equity instruments, there we have equity heading in the balance sheet. There are two items in it, equity share capital and other equity. Where will it go? So it will go in other equity. In the equity share capital, original equity shares will come. All these things will go into other equity, as I have raised funds through debentures which are irredeemable. So it means that these debenture amount will be shown in the other equity. Is it clear? After that, the third feature, if the borrowing from which I loaned out money, if it is convertible in the future. Suppose I took money from a person on debentures. Now I said after 5 years, see, I will convert these debentures to a variable number of equity shares. The number of equity shares is variable. I haven't disclosed the number of equity shares till date. I will give you the same amount of shares on that day, whatever share price will be in market. I can't tell you the exact number. This is a contract to issue variable number of shares. I have entered into a contract in which I raised money, and against this I have to issue a variable number of shares of my own company. Contract to issue variable number of shares comes under what? Financial liability. But this time I said that I would issue debentures, and then said that after 5 years I will convert them into a fixed number of equity shares of my company. Okay, fixed number of shares. Suppose I said I'll issue 1,000 equity shares after 5 years of my company. After 5 years, 1000 equity shares will be issued. It will be non-redeemable. Just they will be converted in my company's 1000 number of shares. Clear? So here I said compulsorily I am converting 1000 number of shares. Compulsorily I am going to convert 1000 number of shares after 5 years. There will be no redemption. Nothing will be there. So what is this? A contract to issue a fixed number of on-equity shares. So here I raise money from debentures after 5 years, but to close this debenture, what will I do? After 5 years, I will give 1000 shares to the others. I will issue shares of my company. It means a contract to issue a fixed number of shares. It is under the heading of equity instruments. So we classify it as equity. It means if the borrowing that's there are convertible into a fixed number of on-equity shares, then you see, are they compulsorily convertible? Compulsorily convertible will come under the definition of equity. Okay. But if it is convertible into a fixed number of shares, then you have to check whether it is compulsorily convertible. If yes, then it will be equity. But if it is not compulsorily convertible, it means that suppose if it is convertible at the option of issuer, I said I am raising money from the debentures. After 5 years from today, 5 years later, if I feel like it, I will redeem it in cash. And if I want to, I can issue 1000 equity shares to you guys. What did I say? If I want to, I can redeem it in cash. And if I want to do something else, I will convert all of them into 1000 equity shares of my company. It means I have an option. I have an option to convert it. Who has the option? The issuer has it. I am the issuer entity. So if the issuer has an option to convert a particular borrowing, so in that case, you would classify it as equity. Why would you do that? Because here I have the option. If I want, I can give the other party cash or give them a fixed number of shares. Sir, I have an option. I can pay cash, but I can't be forced. Can I? No, suppose to the other party, I issue equity shares after 5 years. So the debenture holders who are there, they cannot pressurize me to give cash. They can't force me at all. Clear? Because I had the option, it was my desire. I had no obligation on my part to pay in cash. I had no obligation to pay cash. So this financial liability can't be there. And I have an option to give a fixed number of shares. So I will assume it is an equity instrument and classify it in equity. After that, another scenario is created in it. I said convertible would be in a fixed number of shares. But on convertible, I gave the other person an option. This time option is with the other one. I raised funds from debentures, and what did I tell the debenture holders in front? Look guys, after 5 years you have the choice. If you want, you can come and redeem this for cash. Or if you want, you can take 1000 equity shares of my company. You can take cash if you want, or take 1000 equity shares. Fixed number of shares are also visible, and the other party may also ask for cash. So this time my part has an obligation to deliver cash as well. If that person comes asking for cash, I won't be able to refuse because he has option. Means there can be obligation to pay cash, so there is a financial liability. But he may come back and ask for a fixed number of shares, so it means that equity instrument is also there. Means one instrument, the debenture which I raised, there are two qualities in it. So it has both the quality of financial liability and also the quality of equity instrument. So such instruments or items are called compound financial instruments. Compound financial instrument means such an instrument which contains both financial liability and equity instruments, which has both features combined, is called a compound financial instrument, which in short is called CFI. Remember this CFI. Whichever entities are borrowing, it needs to be classified based on its features. I will also take a few examples here so that you get more clarity on this. After this, I have written some things by marking stars. Any entity that borrows with a mix of features of financial liability and equity instrument, it is called a compound financial instrument. Also, for clarification, a point has been mentioned which many of the students make mistakes during exams. They also get confused about what those things are. Tell me about compound financial instrument. From whose point of view is it possible? Only from issuers, that is from the entity they are borrowing. When I am withdrawing money, I have to see if it's a financial liability or an equity instrument. If I am an investor, if I am investing somewhere, then that will always be a financial asset for me. There's no such concept as compound. When I invest money, it's an asset for me. On the asset side, did I mention any two items? There were only financial assets mentioned. On the other side, I mentioned two items. One is financial liability or equity instrument, right? So if there is an investor who is investing in any company's preference share or debenture, that is directly a financial asset. Got it? Now after this, just 3 more notes are written in it. Let's see them and then we will see the examples. Okay. Interest dividend income on financial assets is recognized in P&L. What does it mean? If I have any financial assets such as preference shares, debentures, equity shares, if I invested in any of them, so if I invested in it, so I'll get interest or dividend income. Where should I take this? Into P&L only. We used to do the same before. If I have taken any money from any financial liability, so sir, I will have to pay the interest also. What's financial liability? Raised money from debentures. What kind of debentures? Redeemable. I raised money from preference share, redeemable. Even that's financial liability. But if you talk about the time of AS, there the preference shares always came in capital. This time preference share can also become financial liability based on its features. So if there are any financial liabilities, if you incur interest or dividend expenses, where will you take it? P&L. But if you talk about the old times, preference shares were always part of your shareholders fund. Dividend on preference shares was P&L appropriation, that is directly paid from retained earnings. It was not shown as an expense in the P&L account. But whole scenario has changed by IND AS. Now if your financial liability is preference shares, then its expense will also go to P&L. Just remember, if any financial liability is there, then expense should be booked in P&L, whether it's interest or dividend. After that, any particular borrowing from which I have taken money, if you classified it as equity instrument, if there's any interest or dividend expense, how will they pay? From retained earnings. So let's say I took money from the preference shareholders, it is irredeemable. I raised money from debentures, they're irredeemable, so where will they go? They'll be classified as other equity instruments. Whatever interest or dividend will pay, it will come from retained earnings. Because where do we get the money for equity owners? After earning whole profit from P&L, it's distributed to owners. In a way, we are calling them owners and equity instruments. So we will give them money from retained earnings. So their expense will go in retained earning. From exam point of view, this point wasn't very helpful, okay? Let's look at some examples so that you get clarity on the whole topic. Then we will look at its accounting. First of all, see what category of asset or liability the cash bank will fall under. Okay, I have created 4 columns: financial assets, financial liabilities, equity instrument, and or there is no financial instrument, meaning other asset or liability as per other IND AS. Cash and bank are financial assets. Trade receivables and bills receivable are financial assets. Giving loan is financial asset. I have invested in equity and preference shares. Debentures are financial assets. I invested in a company's convertible debenture, or I invested in a company's irredeemable preference shares. What will happen then? If you are investing in financial asset, then you don't have to overthink about it. I deposited a security deposit somewhere. So since I deposited it, I'll get it back in the future. So I have the right to receive the cash flow, which means it is a financial asset. After that, PPE, property, plant and equipment, this is done by IND AS 16. There is no right to receive cash in this, not a financial instrument. Inventory is governed under IND AS 2. It is not a financial asset. Intangible assets are not financial assets. What will prepaid expenses be? Think about prepaid expense. Some people consider them financial assets. Check the nature of the prepaid expense. Suppose I have incurred any expense. Okay, I paid in advance. I spent more for expenses. Let's say that I was supposed to pay 1000 for current year, but I gave him 1500. So for me, 500 rupees was left as prepaid expense. So what do you get for it? So sir, in the future you will get the right to receive service, not the cash. Meaning it's not financial asset, it comes under other assets. After that, your advance given for goods and services, I have given the other person advance 10,000 for goods and services. What is this? This is also a normal asset. It is not your financial asset. It's not that because I have paid an advance to receive goods or services, not to get cash in return for this advance. My asset is there, but tell me, will I get cash in return for this? After that, investment property. What is investment property? Your building which you give for rent. So this is covered in IND AS 40. These are not any of your financial assets, okay? Then TP or BP, trade payable, bill payable. So what does that mean? Financial liability. Redeemable preference shares with mandatory interest. Preference shares that will be redeemed, and interest is also mandatory. So this is your financial responsibility. Don't call this a normal equity instrument. Preference share is redeemable and also has mandatory interest. So the whole thing's nature is financial liability. After that, loan is payable in cash with interest. You have to pay it, so it is financial liability. Security deposit taken. I have taken any money for security deposit. I am obligated to return the money in future. It is a financial liability. Income received in advance or earned income. I received some income in advance, so this is liability, right? But now tell me, is this financial? No, because this is my liability. In return, what do I have to give in the future? Do I have to pay cash? No. In the future, I have to provide services for which I have received income or provide goods. So I don't have an obligation to deliver cash, so it will fall under normal liability. Tax liability or tax refundable other assets, other liability. I've mentioned financial assets are not liability. After this, irredeemable preference shares or debentures with a discretionary interest. Okay, irredeemable preference shares and debentures will not be redeemed and interest will be discretionary. This is feature of equity instrument. Compulsorily convertible preference shares or debentures with a discretionary interest. I've compulsorily issued convertible preference shares with discretionary interest. What are compulsorily convertible? For this instance, let's assume I'm talking about a fixed number of shares. Okay, that's the assumption. Fixed number of shares are compulsorily converted, so it's equity instrument. Interest is also discretionary, so this is a complete equity instrument. After this, I have issued a redeemable preference share with a discretionary interest. Preference share is redeemable, so by nature it's a financial liability. But the interest that will be paid on this is discretionary. I'll give it if I want. So this has both features in it. It has a feature of financial liability and equity mixed together, so it is a compound financial instrument. I've ticked both of them, financial liability and equity. After this, it's irredeemable preference share or debenture with mandatory interest in irredeemable equities feature. Mandatory interest as financial liability means it's a compound to compulsorily convertible preference share issued with mandatory interest, so compulsorily convertible in fixed number of shares. It's an equity feature. Mandatory interest is a feature of financial liability, means it's a compound instrument. After this, preference shares are convertible at option of the holder. If the other party has an option and wishes, they can convert it into fixed shares. Or if they want, they can take cash when the other person has the option. In that case, it is a compound instrument. I have already told you about this. So we have seen the entire classification on which asset is a financial asset, which is a financial liability, which is an equity instrument. Now we move to the accounting part. So first, look at the methods for measurement and recognition of financial assets and financial liabilities. You need to recognize financial assets and financial liabilities in your books. So there are some methods for this. First, let's talk about financial assets. This IND AS provides 3 methods to show your financial assets. The first method is amortized cost method, which is SEM in short. Second is fair value through other comprehensive income, which is FVTOCI. And third is fair value through profit or loss, which is FVTPL. The financial assets are shown in the books using any one of these 3 methods. So does the entity have a choice? Can it show under any method? No, the entity has no choice. There are some conditions being set by IND AS. Based on those conditions, entity has to choose one of the 3 methods for its financial assets. Suppose I have any financial assets. Let's say I've invested in debentures of some company. Now, which method should I apply? According to the IND AS, if the company's intention is to hold that particular asset till the maturity. Suppose I invested in the debenture of the opposite company. Let's say after the period of 5 years, that debenture will be redeemed. So let's say my intention is that I will hold the debentures for 5 years. That means I will hold it for 5 years till maturity. If I hold it till maturity, then apply the ACM approach, which is amortized cost method. So when you have an intention to hold it till maturity, and you know what your intention is, in this particular asset, the contractual cash flows, which means the cash flows decided in the contract with the other party. It must be interest or principal amount. These 2 things will be decided. If you want to take that, then use the ACM method. After this, if I have invested in debentures of a particular company, but this time my intention is not to hold the assets till maturity, my intention is to hold the assets for some time, then sell it before the maturity. Yes. Suppose the opposite company issued a debenture and I invested money in it, then it is a financial asset. Now, how do I classify in my books? Which method should I use? I'll check my intention for this in practical life. You see the intention that it's a 5 years period. I'll hold it for 3 years and sell it at the end of 3rd year. I think at the end of 3rd year, market price will be pretty good. Debentures are listed on market price. So I want to take advantage of the market price. So you will show it on the FVTOCI. When will you show it on the FVTOCI? When you intend to hold the asset for some time. After that, you'll sell it in the market before maturity to take advantage of the market price. Meaning I'll hold it for some time and take the contractual cash flow like interest for a while, whatever the company provides. Then I want to take advantage of the market price. So show it on the FVTOCI. After that, lastly, if you have invested in any particular shares, debentures, etc., just for the trading purposes, only for trading purposes. Trading purpose means you only want to take advantage of the market prices. Suppose the opposite company has issued the debentures today and the company is listed on the exchange. So if the opposite company's debenture is listed and today I have invested 1,000 rupees in it, So what's my intention today? If the price goes up in the market this evening, then I'll sell them by this evening. If it increases tomorrow or day after tomorrow, I'll sell it. Maximum within a week, we'll sell it, taking the advantage of the fluctuation in market price. So I invested only for trading purposes. I don't need any contractual cash flow. I invested for trading purposes. In such case, you should show this on FVTPL, fair value through P&L. So this time our intention is that we are seeking to take the advantage and benefit of the market price, and we don't have any other intentions for this particular asset. So for FVTPL, the IND AS stated after this definition that there are only two items which come under FVTPL. Two financial assets are those that you would show on the FVTPL. What are those? If I invest in the equity shares of any company. See, why does any person invest in the equity shares of any company? When I invest today, I think its price will increase and will take the money. To take the money back, we'll always show it on FVTPL because this is for the trading purposes. You think if I invest in the equity shares of a company, is there any contractual cash flow? There is no interest fixed in the equity shares. So there is no interest, the dividend is not fixed, there is no redemption. So it always appears on the FVTPL. After that, we've derivative financial assets. Derivatives were also due to betting. Assets were arising due to it. So doing betting is a kind of trading. So that means it will be shown on FVTPL always. So that means only two financial assets are shown in FVTPL. Rest are seen based on the intention in practical life. In the exam, you will be given that which method you have to apply. Rest I can tell you, only ACM approach is applicable in the exam. 99% of the questions are from the ACM approach only. The chances of questions from FVTPL and FVTOCI are very less except to 3 selected questions. In the exam, it will be given which method you have to use. There is a note written, pay attention to it. I invested in the equity shares of a company. So the investment I made in the equity shares is usually shown in FVTPL. But IND AS gives you a choice. You can invest in equity shares of any company you like. You can show it on the FVTOCI. This will be an irrevocable choice, meaning in the future, I won't be able to show this investment in equity shares on FVTPL. I will have to show it on FVTOCI for whole life. Why was this choice given? I invested in the equity shares of a company. So this will be considered as an asset for me. This can never be shown under ACM method as they don't have any maturity to hold till maturity. It will generally come under FVTPL, but at times FVTOCI conditions can also be satisfied. How? I thought of buying the Reliance equity shares. So I invested money in it and I thought of keeping it for 3 years. I'll sell it in the market after 3 years. I can do that, right? So I will hold it for some time and then sell it so that I can show it in FVTOCI if I want to. But if I choose to show this investment in FVTOCI, then this investment can never be shown in FVTPL again. Please keep that in mind. After this, see the method for financial liability. Suppose I raise money from debentures, I raise money from preference shares, which is a financial liability, or if I raise money from loan. How can I measure it in my books? For financial liability, we use the ACM method, amortized cost method. Because there is no intention here that we will hold it till maturity or before maturity. But this is a liability and we have to pay it and get rid of it. You will use only the ACM method on financial liabilities. There are 2 types of financial liabilities on which you apply the FVTPL method. One is a derivative financial liability and the other one is a financial guarantee. We will understand them later on. Rest, for the financial liability, we will always apply the ACM method. Now we have to understand the amortized cost method, according to which we do the accounting of assets and liabilities. Accounting will be the same. The assets will be debited and in the case of financial liability, it will be credited. The perspective and method of accounting is exactly the same. So I will tell you all the accounting in the amortized cost method. So it is a very simple method and you have to learn it well. And once if you learn this method, then you need not work hard for the concepts of this IND AS anymore. We can expect important questions majorly from this concept. Now we will look into the amortized cost method, ACM. How will you do accounting in this method? So this method tells us to initially recognize any financial asset or financial liability of the entity at its fair value. And the IND AS mainly talks about prioritizing the fair value. If there is any financial asset or liability in your books being recorded for the first time, it will be recorded at the fair value. Today, if I invested in debentures, it needs to be reflected in today's fair value. Today, if I withdrew funds from preference shares, which are a financial liability, I must record them at fair value. So what's a fair value? Now the most important thing is, what is the fair value of any asset? What's called as fair value? What will be the fair value of financial asset or financial liability? So I explained the fair value for that. If the transaction is being done as per the market terms, so the amount at which I did the transaction, that is the amount I received. If it's my financial liability, then I must have raised the money. So the amount I received, or if it's a financial asset, I give the amount. I give money for investing in asset in this case. So for today, whatever amount I paid or received, on that particular value, we will book the financial asset or financial liability in our books. That will be its fair value. Suppose I invested 1,000 rupees today in a company's debentures. I say the transaction that happened is according to the market terms. So I know what entry to pass for the investment in debentures, which is a financial asset for me. Entry will be done as to bank 1,000 rupees. This will be the fair value of the asset. Let's say I withdraw money from preference shares and they are redeemable. Means they are in financial liability nature. Suppose I raised 1,000 rupees from preference shares. So what entry will I pass if it is according to the market terms? We got 1,000 rupees from bank and this is the fair value. So we'll receive to preference shares 1,000 rupees of financial liability. Whatever amount I have received or given on market terms. Assume that as fair value, record the transaction on that. Sir, what are market terms? What do market terms mean? It is something that is generally happening in the market. It's not surprising or something new for the market. Nothing new, the market has always been like this. If it's a normal transaction, it's called as per market term. Let's talk about off-market transactions. What are they? It's a transaction that does not happen as per the market terms. This is a completely new thing for the market. Something that is a completely new transaction for the market. This is not generally seen and is very rare. So in that case, you know what to do. You will be given the market interest rate in the question. The interest rate prevailing in the market for similar transactions will also be given. Then you will have to calculate the fair value. How to calculate it? In that particular instrument, the future cash flows I will receive for financial assets and the future cash flows that I will have to pay for the liabilities. I need to calculate their present value using the market interest rate, and that amount will be their fair value that needs to be recorded. Let's take an example. I have written an example of market terms. First understand this example and then I will revise the notes for you. A limited company has issued 10% debentures with a face value of 1 lakh. They have been issued at 94,000 rupees. Interest will be paid annually and they will be redeemed at face value at the end of third year. I will pass the journal entry for first year, so I have noted down PV factor. So A limited issued 10% debentures worth 1 lakh with a face value of 94,000. On this, every year I have to pay 10% interest on the face value. Interest is calculated on face value. At the end of third year, I have to redeem on face value and pass journal entry. How to record on zero time? This is a financial liability because it's an obligation to pay cash in the future, right? So it's a financial liability for me. So how do I record this at fair value? See if the transaction is on market terms or off market. Now I don't know if it is off market or on market. So from the exam point of view, it's a very simple thing. How to know if the transaction is at market terms or off market? If the question mentions the market interest rate prevailing in the market on a similar instrument, if that is the case, then understand that it is an off market transaction. The market interest rate is not mentioned anywhere in the question for similar instruments. So you can assume that the interest rate is according to the market terms. Normally debentures are issued in the market. They will say this is issued at a discount rate. 1 lakh debentures are issued at 94,000. Are debentures not issued at a discount in the market? Yes, they are issued at discounts. It's not a new thing, it is a normal thing. This is as per the market terms. So if the market interest rate is not given in the question, then it is on normal market terms. In this case, the price at which the transaction occurred, record it at the same price. How much was it? 94,000. So bank account debit to 94,000 to 10% debentures, 94,000. I'll pass this entry at zero time. I've passed this in financial liability. Now I will link this to something you would have studied in your intermediate level in accounting standards. In those debentures at zero time, you must have passed the entry as received from bank 94,000. To debentures, always we've learned to record at face value. So record it at 1 lakh face value. Difference of 6,000 in debit side. Enter that as discount on issue of debentures. But the IND AS completely changes the perspective. It says that 6,000 is your expense. It is worth 1 lakh. Against the debenture of worth 1 lakh, you paid 94,000 rupees. In the future, you will pay 10% interest on the face value. It will be redeemed at face value, which means you paid 6,000 extra. So this amount should be included in the life of this instrument, right? Why are you calling it a discount? IND AS said show it for 94,000 at 0 times, which is its fair value. What you have received or paid is the fair value in market terms at 0 times. The cash flow you will get in the future. Now you calculate the present value of future cash flow at a rate that makes it equal to this. In future, whatever cash flow you have to pay, tell me. In this instrument, every year we have to pay 10% interest actually. 10% of the 1 lakh face value is 10,000. So for 3 years, 10,000 will be the interest. In the third year, 1 lakh will be redeemed. So now calculate the PV of future cash flows. In this instrument at a rate that brings the net inflow at 0 times to the same amount as the 90,000 rupees inflow. Now calculate the PV of the future cash flows at a rate that makes it equal to 94,000 and then charge interest on this instrument at that same rate. So you have to open this instrument at the same rate. As I say open every time, it means unwinding it. Whenever it's on the market terms, then its unwinding will happen because it is shown on the fair value. How will the unwinding in market transactions done? It will be based on the EIR, which means effective interest rate. The rate at which the PV of future cash flows makes it equal to the net cash flow at 0 time. It is called as EIR. Do we have to calculate the EIR? This will always be given in the question in FR. There won't be any question in the exam where EIR isn't given. We had a question in the question bank where the EIR was not given because it was an illustration of the ICAI. It was given for the explanation purposes. You will always get EIR in the exam. Still, I have taken an example for EIR. What was the example? I calculated the PV of cash flows first at 12%, then at 13%. So here both times at 12% and 13% for the future cash flows that I have to pay, their present value at 12%, it came out to be 95,220. At 13% PV, it came to be 92,910. But what I need is a rate that will get me close to 94,000. I need to do interpolation now to bring it to 94,000. I covered interpolation in SFM and discussed it thoroughly in the lecture. As this is a revision lecture, I won't go over it again. I wrote and explained the formula for interpolation, that is like the unitary method in mathematics. Lower rate plus value at lower rate minus required value divided by value at lower rate minus value at higher rate multiplied by higher rate minus lower rate. The lower rate is 12% with which we did PV. Adding value at the lower rate is 95,220 minus the required value is 94,000. We need such rate. Divide by 95,220 value at lower rate minus value at higher rate means value at 13%, 92,910. Multiply by higher rate minus lower rate, 13 minus 12, you will get 12.53%. So if you discount the future cash flows by 12.53%, then it will be equivalent to 94,000 at 0 times. Now I know what rate to use to unwind 94,000. What does unwinding mean? At what rate interest to be charged on this particular amount, so that the amount at maturity is nil in the future. That's what we do in the amortization table. I have been saying this since in IND AS 16. It's useful in IND AS 115 and 116. After which we had complete confidence on this topic. We did not have any discussions on this topic. If you are watching the revision video directly on YouTube, catch up on previous revision videos first for a better understanding. You have to open it at a rate. That means if you open this 94,000 at 12.53%, then the balance will be finished at maturity. I have also made the amortization table for this. You have to open it at this rate. Charge EIR. How to make the amortization table? It is of 5 columns. What does this table convey to you? This table elaborates on the finance cost for a liability and the finance income for an asset. This table displays the ledger account of that particular liability or asset, and you get same answer with both. But note that you have to make a table in the exam. Why do we call this as amortization table? You must have found the reason in this IND AS. We have to make this table because of the amortized cost method. So we call it an amortization table generally. The table has 5 columns. The first is your, second is opening balance, and the third is interest. We charge at the same rate at which we had done the PV. And now comes the 4th column in the table, which is actual payment column, and 5th one is the closing balance column. The opening balance on which we recorded the debentures was 94,000. That's the entry that was passed. Now at what rate should I open this? We have to open it at EIR. We found the EIR. In the exam you will be given this EIR, so you need not do this step. Okay, so amount came as 11,778. Now actual payment, keep in mind that it will be from the actual interest rate. The actual interest rate is 10% on this debenture. The debenture holders don't know anything about the EIR. They want 10% interest on the face value. 10% of 1 lakh is 10,000. That will be the actual payment every year. The actual payment and interest charged by the EIR is completely different. And I have already explained the logic behind this in my lecture. To get the closing balance, add the opening balance, interest, and then subtract the actual payment made. You got the closing balance for first year. Now this will become the opening balance for the second year. Add the interest from the EIR, then deduct the actual payment. You will get the closing balance. This will be opening balance in the third year. Charge interest from the EIR, subtract actual payment. At the end of the third year, the closing balance will be 0. As you have paid, liability will end. If we had assets, it would have been finished. This is its accounting. It's very simple, the accounting of financial instruments. So you made the entry at 0 time in first year end. Now you have to do just 2 things. I had to add interest and open it. Since I had recorded it in a compressed form at fair value, I had recorded a liability of 94,000 on the debenture at 0 time. How much do we have to pay for the debenture? If 10,000 over 3 years and 1 lakh in the last year, means total 1,30,000 has to be paid in absolute terms. And in the liability books, it's 94,000 in compressed form because it's the fair value. So I have to open it, and I call the process of opening as unwinding. This means you have to make this amortization table. How much interest did we open in the first year? 11778. Liability needs to be opened means increased, so liability will be credited to debentures, and interest expense or finance cost will come in debit, which will go to the P&L 11778. At the end of the first year, there will be one more thing. Reduce the liability from actual installment payment, so 10% debentures debit to bank. How much liability has been reduced? In the first year, coupon of 10,000, so 10,000 to bank. These 2 entries which passed at the end of first year, we can make it single entry, which I have already taught you. The 2 different components that are in the entries, just write them as they are, and the remaining difference amount in the entry that is there, put it in the account. The 2 things which are common in both the entries. So this is how your second year and the third year entry will be made, and the liability will be over. That's an asset. Let's say I invested in debentures of a company. Here, instead of saying A Limited issued, it should be A Limited invested. So what would have happened first in the initial recognition entry? Investment in debentures would have been included in the bank, 94,000 and 94,000. How much does it open every year? Investment in debentures to interest income in same amount and payment in same amount. Everything remains same, just the asset accounting is done. Rest the procedure is same because it's of market terms. So that means if you have shown it in terms of market, we will talk about off market later. Let's complete the topic about market terms first. If your transaction is on market terms, if it is on market terms, then show the financial assets and financial liabilities at fair value at 0 time. After showing it at fair value, open it every year from the EIR. In such case, you will always be given EIR in the question. This means this transaction is according to market terms. If there's a transaction according to market terms, the amount received is given as your fair value. You have to open each year with EIR and create an amortization table. Every year on this, you will charge interest expense or interest income as per the asset or liability and create a 5-column table. Now what discount rate do you take to open this? EIR. I have already told, I am just showing you notes. I have told you general entries. You can also see the screen for assets and liabilities. I don't think I need to explain this again. The EIR is the rate that makes the future cash flows to PV. EIR is the rate at which you bring the cash flow equals to the cash flow at 0 time. This is usually given in the question. If it is not, then you will have to use the trial and error method. After that, there is something called transaction cost, which I will discuss with you later. Now take a look. It's all done. How to do accounting on market terms. This was the accounting for you. Now if there is an off-market transaction, then how will its accounting be done? We will also look at an example which I discussed with you in the lecture. How will you know from the question that this is an off-market term, and in that case, how will you do the accounting? Let's see an example. A Limited provides a concessional loan of 1 lakh rupees to its employees at an interest rate of 6% per annum for 3 years. The employee will pay interest annually and the principal amount at the end of the third year. Market rate of interest is 10% per annum, past general entries for the first year. Now look what happened. I am A Limited and I have given a loan of 1 lakh rupees to my employee. Loan was given for 3 years and 6% interest will be paid annually, and at the end of the third year he will repay the principal of loan amount. Now I have seen that in the market for the same loan, if anyone gives a loan for 3 years for 1 lakh rupees, the market generally has a 10% interest on it. And I gave it to employee at 6%. What is this for? Companies sometimes do this for their employees. See, there was a dear employee of mine. This poor guy needed money to build a house. He was very upset with his wife. She must have scolded him about a house, but he cannot build a house. So he went to the bank to take a loan. So the bank offered him high interest rate, which was the market rate, but he could not afford that. So he came to me crying that, boss, I need money. I said, why are you worried? I am here for you. You do one thing, take a loan of 1 lakh rupees and I will give you at 6% interest rate while the market rate is 10%. This is clearly an off-market transaction, because when you give a loan of rupees 1 lakh in the market, you give it at 10%. The market rate is 10% and I am giving at 6%. If there is off-market transaction, you will be given market rate of interest in the question, which will generally be higher as per your loan. And if I tell the employee, you see in the market you get a loan at 10%, I will give it to you at 12%. The employee won't say anything at that time, but later in his mind he will abuse me so badly. He will go home and curse me that boss is a cheap person, let's get loan from bank. The market rate of interest is generally higher and what you are doing transaction is lower, so you can understand this is an off-market transaction. So it's an off-market transaction. If it would be a transaction on market terms, then I should have charged 10% interest from the employee. How much interest I am asking the employee to give me? I am saying that you give me only 6% interest. If it's off-market transaction, you will get market rate of interest. If given in question, it's off-market. If the market rate of interest is not given, then you just assume it at the market terms. In an off-market case, how will you record it? Initially need to show it at fair value. What is my financial asset? I provided the loan. I am A Limited and I provided the loan. So for me, it is a financial asset. Then what will be the off-market case if it's shown in fair value? What it will be, do one thing, whatever cash flow you are going to get in the future, make it PV by using the market rate of interest. Convert it to PV for any future cash flow. I will get cash flow in future as I have financial assets. If I PV it using market rate of interest, then it will be my fair value for this particular financial asset. Why is this fair value coming? I will tell you the reason behind it. Tell me in this particular case, what will I get in the future? What is the actual cash flow that we are talking about? Whenever the word cash flow is mentioned, it is referring to the actual cash flow. For loan of 1 lakh, the employee will pay 6%, which is 6,000 rupees in first year, 6,000 rupees in second and in the third year each as interest, and 1 lakh rupees as principal. This will be the cash flow. Therefore, in the future, the total amount I will receive will be 1,18,000 without the time value of money. Okay. So the total amount 1,18,000 will be received in the future. If a normal person would have given a loan, he would have given it at 10%. So a 10% loan would mean it should include 10% interest component in future. If I remove the 10% interest component from the future money, then I can figure out how much loan I should have given today. If I would have given that much loan amount today, I would have received 10% in return. Do you understand this? Removing the interest component from the future amount. This process is called PV. So how much interest component should I deduct from the future amount? Market rate of interest is 10%. So if I PV future cash flow by 10%, it will be 90,016. So what does this mean? If I would have given the employee loan of 90,000, approximately 90,000 instead of rupees 1 lakh today, then I would have earned only 10% income from this cash flow. Furthermore, with 6,000 or cash flow of 1 lakh, if I give the employee a loan of 90,000 instead of 1 lakh, I would get 10% income, which is the market interest rate. I hope this is clear. So this is the fair value of 90,000. Now what will I pass as the journal entry? Loan to the staff, which is a financial asset for me. The amount is 90,016 to bank, but I paid 1 lakh to the person in front of me. It should have been 90,000 when shown the fair value of asset, but to bank it was shown 1 lakh because the actual amount was 1 lakh. So always keep in mind that whenever there is a transaction at off market terms, there will be a difference in the journal entry. If it was on market terms, there was no difference in the journal entry at 0 time. But in such cases, there will be a difference in the 0 time journal entry. Now where to take that difference? So generally something comes to our mind, P&L. So take it in P&L. This Ind AS also says that you take it in P&L. However, this Ind AS says that if there is a special relationship between the two parties involved in the transaction, then for special relationship, there are some specific accounts that have been mentioned. You have to take it to that account. I will discuss that account with you guys once and then we will move forward. Okay. Here you see the general entry at the initial recognition. There will be a difference in it if it's an off market terms transaction. You must have understood why this happened. You can generally put this under P&L, but see here in the chart I made, I said if there would be any special relationship between the parties. So in that case, you would take it to a special account. So a special relationship can be of three types. First relationship is between employer and employee. In the transaction that just happened, I give the loan to my employee, so we have a relationship of employer-employee. So in this case, that is the relationship of employee-employer. So the difference between employer and employee relationship will show in the prepaid staff cost. When an employer gives loan to its employee at concessional rate, it will always be difference in debit. For me, its financial asset difference will be in debit. So what should I say? See, the employee should have been given a loan of 90,000, but I gave 1 lakh, so I mean I gave 10,000 rupees extra to the employee. So why did I give the extra amount? I am assuming that I have paid my employee for the services that he has provided to me. He has come to work in my company and is working. I would have paid him for it. So I will call it prepaid salary or prepaid staff cost. I have paid him in a way. For the service he will provide me over a loan period of time, I have given him 10,000 extra for it. So what will it to me? It is a prepaid staff cost. This is as per Ind AS 19 employee benefits. According to its Ind AS, over the loan period, we will take it in P&L. Every year we will take this to P&L. We will see example now. From the employee's point of view, it's an advanced salary income for them. But the employee doesn't have to do any accounting. Ind AS applies on big companies. Why it will apply on employees? After that, it's a lesser-lessee relationship. Lesser-lessee relationship means, let's say I am a person who has taken a specific machinery on lease for 10 years, and for that I have given a security deposit of 1 lakh rupees to the lessor today. When will I get back the security deposit? When the lease period is complete and I will hand over the machine to them. It happens, right? I am taking an asset on rent from someone, so I give him security deposit when he needs it. For the security deposit, I am generally not getting the interest from front. Ultimately, what I did was I put down a security deposit for 10 years. So in a way, I gave him a loan. I am a lessee, so I should have received interest on it because the interest is always available in the market, right? Whatever the difference will come in this case, fair value and the money I paid. Where will I show this? I will assume that the service that I have taken on lease from person in front, the asset that I have taken on lease rent, I have given money in return for that, I have given it in exchange for rent. So I will call it ROU asset. What is it for lessee? ROU asset. We've already read this in 116, and for the lessor it's a kind of advanced lease income. What will the lessee do as depreciation in this ROU asset over the loan period P&L, because depreciation is applied in ROU asset as per Ind AS 116. After that, if there is a parent subsidiary relationship, suppose I am the parent company and I have a subsidiary relationship. A subsidiary company is one where I have more than 50% control. What is a subsidiary? Subsidiary is like my son. My son needed a loan. He went to the bank and the bank said, I will give you a loan at 10% because my son is unknown to the bank. But my son came crying to me and said, Father, I need a loan. I said, don't worry, I will give you loan, that too at lesser interest. That is, I will give you a loan at 4% interest, where the bank is giving you loan on 10% interest. It could be that I give a loan without interest because he is my son, meaning the subsidiary is my son. So in this case, the transaction I have made with the subsidiary is not on market terms, it's off market. So I will calculate the fair value of this loan, the financial asset for me. I will calculate the fair value, it will be different and the money I paid will be more, so the difference will be same on my debit side. Now where should I put this difference? So tell me, there is a special relationship in this difference, a father-son relationship. I am the father and he is my son. So what should I say? I gave some extra money to my son. You know, when a father gives money to his son, he calls it an investment. I invested in my son. Your father is spending money on you. He says that we are investing in our son because in the future he will be a big man and earn money for us. He will earn money for us in return and he will take care of us. I will say that I invested this difference in my son, or rather I invested in the subsidiary. I will say investment in the subsidiary, that's it. My son is a subsidiary, what accounting will he do? My son is subsidiary, what accounting will he do? If the son has taken a loan, then for him it is a financial liability. So tell me where the difference will come. Okay, suppose he debited 1 lakh rupees from the bank. For example, let's take the employee who has the fair value 90,000 to financial liability 90,000. That will make a difference on the credit side. Son's difference means financial liability when it is showed, then there will be a difference on the credit side. He will say when father invested in it, the son will say my father invested in me. How will the father invest? He will invest in the equity shares of a company. How do you invest in a company? You buy equity shares. So the son will say that he gave his equity shares to father in a way, but he actually did not give any equity shares. So he will say equity instrument, capital contribution from parent, which is shown in other equity. It is not equal to the equity shares, but it is a form of equity instrument that will appear in the other equity section of your balance sheet under capital contribution from parent in the subsidiaries balance sheet. Got it? So he will show the difference in credit which will come from equity capital contribution from the parent. Okay, after that, it's also possible that many a times when the father needs money, he can take a loan from his son. Means father can take a loan from his son. So means I am the parent company and I am taking a loan from my subsidiary company, which means the subsidiary company is giving a loan to its parent company. Subsidiary company is lending cash to its parent company. For subsidiary company, it would be considered financial asset as it has given the loan. Son has given loan to father. So the son has given a loan to the father at a lower interest rate compared to market. So it's a financial asset for him. The transaction is off market. So there will be a difference in debit. Now where should the son put the debit difference this time? Sir, put it as an investment in the name of parents. Have you ever heard of a son investing in his father? Such a thing never happens, sir. In practical life, have you ever seen this? A father must invest in his son, but a son never invests in his father. So what does a son do? When a father invests in his son, right? He does so with the hope that the son will earn some income, earn some return and bring it to me. So when there is a difference in the debit of the son's books, the son will say that I gave my income to my father, I earned and returned it to my father, I earned and returned it to my father. So he will debit it as dividend distribution. Whatever the difference is, he will call it dividend expense to say that he has returned it to his father as dividend earnings. He will book it under dividend. So the father will book financial liability. For the parent company, it's financial liability because the loan is being taken from subsidiary. So there will be a difference in credit. What would I say? I received income from my son, which means dividend income. That will be reflected in the retained earnings. All right. This is the treatment of your difference. Otherwise, if there is no special relationship, then put it in P&L. What is the treatment for investment in subsidiary? We have IND AS 27110. You don't need to write it. We'll see its treatment later over the period in IND AS 27110. You have recorded this at fair value. At zero time difference, because of employer-employee relationship, we put in prepaid staff cost. This prepaid staff cost comes to 9984 over the loan period of 3 years. I will write off it in P&L. 9984 divided by 3. So at the end of first year, staff cost will go to P&L. To prepaid staff cost amount came as 3328. This will be passed at the end of all 3 years. Besides this, what happened every year? At zero time, I have recorded the loan at fair value. How much is the loan asset booked? At 90,000. What we will get from the front employee? 6,000 for 3 years and 1 lakh at the end of the third year, total of 1,18,000. And I recorded asset at 90,000 in compressed form at fair value. So this will have to be opened. How to open the asset? By charging interest income. Amortization table needs to be prepared. How do we open it? So prepare the amortization table for financial assets. Same opening balance. Sir, please charge interest. At what rate will we start charging interest from? From the EIR. But you remember, whenever there is an off-market transaction, then you do PV at zero time at the market rate of interest. You are doing PV and have recorded the transaction at market rate of interest. Open it at that rate with which you had done the PV at zero time. Do it at the same rate. It will do the work of EIR. It will do the work of EIR. Keep that in mind. With what did I do PV? With 10% market rate of interest. So this will work as my EIR. This will work as my EIR. So see, I opened it from 10% interest. The actual payment is from the employee for the first year. 1 lakh rupees at 6% interest, which means 6,000 rupees will be given. I recorded that. The closing balance came. Do the same. Asset balance will finish off. What will be the journal entry at the end of first year? Loan to staff will increase to finance income that you opened, and an actual payment I will receive. Bank to financial assets 6,000. Like this, you can pass the entry every year. Accounting is done. So you have learned the entire accounting, your amortized cost method. The most important is we have covered 8 to 10 questions related to this during our lecture. See here, you show it at fair value. There are market terms. Same amount which you gave is received. Consider it as fair value. If it's off market, then market interest rate will be given in the question. You do PV of future cash flows. That will be your fair value. If it is at market term, then market interest rate will not be given. It will be directly given in the EIR question, and then it will be used for opening. Okay, now one more thing I need to tell you. It's about transaction cost. So you have to keep in mind at zero time you'll be recording at fair value. In fair value, I've written another thing in brackets, adjusted with transaction costs. You will record financial assets or financial liabilities at fair value at zero time, which will be adjusted by transaction costs. Suppose I raised money through a debenture, rupees 1 lakh from debentures, but I incurred a transaction cost of 2000 rupees while raising money. It cost money, right? Processing fees, document processing fees. There can be a broker fee or a regulatory fee which can be charged under any name like processing fee, broker fee, regulatory fee, transaction fee, or upfront fee, right? They can call it by any name, so we call it transaction cost. So I raised a financial liability, raised money, and my expense on this came out to be 2000. So you received 1 lakh from the bank and 2000 as bank charges. So the net amount is 98,000. So in the entry you can write directly bank 98,000. But on the other hand, should we take it to P&L? We can't take it to P&L. This time Ind AS says put them in P&L rather than putting in AS. Okay. Ind AS says, why have you charged whatever the transaction cost is? You have taken money from your financial liability, so this cost was incurred. So let's say we take it over the period, which means we adjust it to the fair value of that financial liability or asset. If it's financial asset, let's say I am investing in the debentures of a company. I invested 1000 rupees and I had a transaction cost of 5 rupees. So I have to adjust the fair value of this particular financial asset. Understood? Suppose the fair value of its financial asset is 1000 rupees. How do I adjust it in the entry? Look, 1000 rupees is in market terms. So this 1000 rupees itself will act as the fair value. Now the asset and the transaction cost are also debited. Expense is also debited. So do one thing, add this to your financial assets. Do you know what entry I will pass? Financial asset 1005 rupees debited to bank 1005 rupees. It's done in the market terms. Similarly, if I took 1 lakh rupees from financial liability, my expense is 2000. So entry will be bank 98,000. What to do about financial liability? Liability of 1 lakh and expense of 2000. Expense is debited and liability is credited. So 1 lakh minus 2000, which means 98,000 rupees. Entry is bank to financial liability of 98,000, 98,000. Transaction cost is given, whole logic is discussed, what has to be done, what to keep in mind from exam point of view. You have to add transaction cost in the fair value of your financial asset and subtract transaction cost from the fair value of financial liability. It's off market, so first you will find fair value by using PV and then you have to do adjustment. I have to tell you this as well. See, you will open the EIR if it is in the market terms, but if it's in the off market terms, then you will do the PV to find the fair value and then assume that the transaction cost is given in the question. Let's take example of 90,000 employees. I have done PV at the market rate here, an amount of 90,000 came, fair value of financial assets came 90,000. Now you were told in the question that A Limited has to bear the expense of 1000 to grant loan. What should I do? Add 90,000 plus 1000 because it is financial asset. Should I add fair value in transaction cost? Yes, sure. You can book it. Financial asset are of 91,000 to bank. 1 lakh plus 1000 of what you gave for transaction cost. Your difference will reflect in prepaid staff cost. What happens after that? You have to open it every year. How to open it? At market rate of interest from which we done PV. No, don't make this mistake. Now when you will open it, if you open it with 10%, then it is not correct. Closing balance is showing nil at the end of the third year. It doesn't show nil. It either shows a negative amount or higher positive amount. It's not nil because you opened it at 10% with 90,000. Now you have recorded 1000 added to 90,000 as a transaction cost. You have either added or subtracted to assets or liabilities and recorded after making the adjustment. Now amount has changed. If you open at same rate, then amount will not be same. If you open 90,000 at 10%, it will be same amount, it will be finished. But if you change this amount to 91,000, then it will not open that much, it will open more or less. The last closing balance will not be nil. So in that case, you will have to calculate the EIR which will be given in question. In such cases, market rate of interest and EIR will be given. In such cases, you have to do PV at market rate of interest and then open it from EIR. This is what I have written, what will work to open discounting rate. Discounting rate that you will use to open in case of market term is EIR, and in off market term use the rate that you use to PV, it will work as EIR. And in such cases, if the transaction cost is also given, then it will be opened from EIR which will be given in the question. Here I have also explained the transaction cost. It means regulatory fees, charges for document preparation and processing, brokerage fees, upfront fees, etc. You add it to initial recognition in fair value of financial asset and subtract it from initial recognition in fair value of financial liability. With this, I have explained entire accounting through the amortized cost method, and I have also taken an example in front of you. You can do questions easily. Here 4 steps are written to solve question from exam point of view. In first step, find the fair value of financial assets and liabilities. In second step, if there is any transaction cost given in the question, then adjust it so you know what amount to record at zero time. In third step, make amortization table, and in fourth step, if question asks to record journal entries, then you should record them. This way you need to follow these steps to solve the question in exam. Next method is fair value through other comprehensive income, FVTOCI. Look quickly, it's not useful for exam. Tell me, where is FVTOCI method applied? It is only available for financial assets, not for financial liabilities. So for financial assets, FVTOCI method is available. How will accounting be done in this? In this method, entity will do accounting same way it is done in SEM. So what's different? Only difference will be on every balance sheet that entity have to bring its financial assets to their fair value. In the ACM method, we record the fair value at zero time. Then we deduct amortized cost from amortization table, add interest from EIR, and subtract the actual payment. In this case, you should apply ACM method, make amortization table, and from that carrying amount will come in books, means interest will be charged from EIR and actual payment will keep going normally. But then the carrying amount will come normally. Now you see its fair value. Suppose in the first year end the carrying amount came after making that table, then interest is charged and then actual payment made is 1000 rupees. Fair value of financial asset in market has become 1100, so fair value has increased by 100. Therefore you need to debit financial asset, then increase it to fair value gain and take this fair value gain to OCI account. That's why it is called fair value through other comprehensive income. Fair value gain loss will also be booked through the OCI account. So in this method, you take the ACM method as it is, just book fair value gain or loss through other comprehensive income, right? Here you will do this. And why did we take it to the OCI? Reason for that is because this is an unrealized gain loss. Did you actually get any benefit from that fair value gain loss? No. It's unrealized, so show it in OCI. Don't take it to P&L. Reason is when we talked about it in IND AS, revaluation surplus, we discussed it in detail. Same reason applies here. After that, see, when the financial asset that you have shown on FVTOCI, while doing its fair value gain loss, its fair value reserve, which will be created in the OCI, some balance will accumulate there. If you sell that asset one day, on that day its fair value reserve, which is accumulated in OCI, you will reclassify it in P&L. One more thing here, if you have shown your investment in equity shares on FVTOCI taking irrevocable choice. If you have investment in equity shares and you sell them in future, then its fair value reserve account in OCI won't be reclassified in P&L. Instead, it will be directly transferred to retained earnings. Okay, this means this is a topic that would be not reclassified to P&L. Remember, it's not very useful for exam. Next method, fair value through profit or loss, FVTPL. In this method, how will you do accounting? FVTPL is very simple accounting method. It says initially you have to record your financial assets or financial liabilities at fair value. So initially all methods ask to record at fair value. After this, what you need to do, it's nothing like ACM. For every balance sheet date, you need to know the fair value gain loss and directly take it to P&L. Why do you take it to P&L? It's unrealized too. But look here, when does FVTPL apply? When assets are of trading purposes. I bought equity shares today. I thought that price would go up and I would sell it by evening till the market is open. The price will increase tomorrow. I will sell it tomorrow. Otherwise, I will sell it in a week. Gain loss will be realized in a week. It won't make much difference. Generally, you can directly book it in P&L. When we apply FVTPL, we will book it at zero time at fair value. Then on every balance sheet date, just check it and any difference in value will be taken as gain or loss in P&L. And beside this, whenever you have an FVTPL asset, a financial asset, and you get a dividend income from it, you can book it directly with coupon rates because we are not doing any accounting like ACM, charge anything from EIR, then deduct actual payment. So here if you get a coupon or something in between, take it to P&L because here we only have investments in equity shares as assets and other are derivatives which don't have any coupons. In liability, there are two things, financial guarantee and derivative financial liability. So there won't be any payment. Here, whatever coupon you get, it's your income. It gets recorded directly in P&L. One more thing to keep in mind here in the FVTPL method. So until now in ACM and FVTOCI, if there was any transaction cost or something, then we were adjusting it to the fair value of that particular financial asset or liability. But in the FVTPL method, you will not adjust transaction cost to fair value of that particular financial liability. Just book the transaction cost as an expense in the P&L. So why we did this? Why did we treated it as an expense in P&L and why did we not adjusted it in fair value? Because in this method, at the year end, we have to take the difference in fair value and ultimately we will take fair value in P&L. Do one thing, as soon as the transaction cost occurs at 0 time, put it in P&L. Anyway, the financial assets and liabilities that come on FVTPL are not for long time. There's no need to create an amortization table or charge any interest from EIR. So why put so much effort? Just adjust the transaction cost and put it in the P&L. Just keep this in mind and it's done. This is accounting using all three methods. Now we will see accounting of compound financial instruments. How we do it, I told you in this chapter you will see three things: financial assets, financial liabilities, and equity instruments. Methods of accounting for financial assets and liabilities are mentioned in IND AS. This IND AS does not mention about accounting of equity instruments. I told you earlier it will tell you to record this amount for equity instruments in some cases, and it will tell left out amount only. And then we came across a compound financial instrument and concept that mixes features of equity instrument and financial liability. So how to do its accounting, now you will learn it. It is very simple and you will find a question on this in every exam, in every attempt. It is very easy topic. Okay, so now we will start it. Now look here. How would you do accounting for compound financial instruments? So for that I have noted down some steps here. Let's take an example. Then after that we will directly look at the steps. It's very simple. A Limited is a company that issued 10% debentures worth 1 lakh rupees. Interest will be paid annually and it is convertible at the option of the holder at the end of the third year into equity shares of the company or will be redeemed at par. I said I am A Limited, I have issued 10% debentures worth 1 lakh. That means I have raised 1 lakh rupees. I have to pay 10% interest every year which will be paid annually. After this, these debentures are at the option of the holder. The holder is the person who buys. Holder has the option to either convert it into a fixed number of equity shares at the end of the third year or redeem it at par. At par means the face value or it means redeem at 1 lakh rupees. Okay. I said if it's convertible at the option of the holder. So this means it is a compound financial instrument. I have told you this, that I have issued a debenture where the financial liability feature is mixed with the feature of the equity instrument. So in this case, how will we do the accounting? For that you are given data in the question. Market interest rate on similar non-convertible instruments is 12%. Record journal entries. So now see how the accounting would be done. Tell me at 0 time what did I do? I raised 1 lakh rupees. Now you have to start from here. I have received 1 lakh rupees, which means 1 lakh rupees came from a debenture which has two components. What are these components? One is financial liability component and other is equity instrument or equity component. A component of equity means if a single thing has two features, then bifurcate it in both. What is the component of financial liability and equity in this? How can we bifurcate this 1 lakh rupees? We need to bifurcate this at 0 time. How to bifurcate? What does IND AS say about it? Look at this particular instrument and see what is the nature of financial liabilities and what cash flows I will have to make in future. Which cash flows I have to do in future as per the nature of financial liabilities if I PV them. The market interest rate on any non-convertible instrument, that much is the financial liability component. Okay, and the rest we can put in the equity component. Sir, why is that? See, if I issue a non-convertible debenture, then the entire debenture would become a financial liability. If someone issues a debenture, then what is the current interest rate on it in market? 12%. So if I tell you the compound financial instruments, that will be generally off market. You will always get market interest rate in this. So what you have to do is whatever nature of financial liability you have, there may be an obligation to pay cash. Just take that and PV it with the market rate of interest. That amount will be your financial liability component. That's as simple as that. So what are the cash flows of the components of financial liabilities? Tell me about the interest rate. It is 10% payable annually and it is mandatory. 10% of 1 lakh means I have to pay 10,000 interest for 3 years as financial liability as cash flow. Apart from this, at the end of third year, holder can take cash, or if they want, they can take equity shares. If he comes to ask for cash, then I have an obligation to pay cash for redemption. Means that the amount of 1 lakh, the redemption amount, it's in the nature of a financial liability. So to call these cash flows, PV them on market rate of return 12% and amount is 95220. It means that out of 1 lakh rupees received at time 0, 95,220 was received as financial liability and the remaining amount was received as equity component. Don't tell the other person that this much amount is there, it's just for my accounting. Calculate equity component amount. 1 lakh minus 95220 is 4780. What would be the journal entry? It is very simple. 1 lakh rupees from bank to 10% debenture, financial liability account 95220 to 10% debenture, equity component account 4780. You can see entry for 0 time in the first year in beginning. It's very simple. Now what will happen here on the asset side? Bank balance will increase, and on liability side, if you look, then 95220 will be added, and in other equity add 4780. Clear? Now here, let me tell you one more thing. I'll give you a question. It will give you more clarity. If I had said that interest on these debentures is mandatory, but at the end of third year, they will compulsorily be converted into a fixed number of shares. So in that case, what happens? See, interest is mandatory, so there's financial liability. It is compulsorily converted into equity shares, means equity instrument is compound. I need to find component of financial liability. What are the cash flows in nature of financial liability? Interest of 10,000 rupees every year. Is there any other cash flow on maturity? This time, if I didn't have to give cash, then there is no redemption amount. Then in this case, you only have 3 cash flows of 10,000 each, which are part of your financial ability. We record them after PV. Clear? Now what you have to do first, you have to bifurcate it. Equity is as it is, we will not do anything with it. Since the IND AS doesn't tell anything about equity accounting, once we record the amount, we do not change it. Even if we have some remaining amount, now you have to record financial liability. Accounting for financial liability, just learned it through the ACM approach. Just do that accounting and continue. We will do accounting for financial liability using ACM approach, means make amortization table. It is recorded at which value? 95220. Now we need to open interest on this with EIR. In this, PV has been done with market rate of interest, so it will do work as EIR, means 12%. Reduce the actual installment, closing balance of financial liability will come, and if you see it in the last year, amount will be 0. If you assume principal installment as payment, they don't accept principal payment in installments, so maximum principal amount of redemption will be your closing balance, which I have mentioned in table here. So what will you do at the end of your first year? Open interest on financial liability, pay the actual payment. Do the same thing in the second year and third year, pay the interest on it. Now in third year end, settlement of the instrument has to be done. See what will happen. If the holders come and ask for cash, what should I do? I have to give it because they had the option. What should I do, sir? Should I debit the financial liability to the bank and close it with a payment? How much? 1 lakh. In financial liability account, only that much amount will be left which you may have to pay. Because we consider the component as the most major in liability, we record it first for the full amount, and anything extra is considered equity. Okay, liability was recorded with priority, so 1 lakh should be the remaining amount, and we had to pay 1 lakh. Okay, so it's finished. After this, there will be equity account with 10% debenture. What should we do? Let it be instrument is finished, then account should also be finished. So debit the amount 4780. Where do we take this amount? We don't need it. Transfer it to retained earnings. When needed, transfer this amount to retained earnings. After that, see the second choice. People will come and say, we don't need cash. I will give fixed number of equity shares that was pre-decided. What entry should I do? Is liability required? No. So debit it. Carrying amount. Do we need equity account today? No, we don't. So finish that as well. What should I credit? Today I will issue original equity shares. 2 equity shares. Capital and amount will be equal to face value. Remaining amount is securities premium. In this example, I did not tell face value of equity share or number of share. Just told you that number of share will be fixed. If exam gives you both, then you have to put that much into equity share capital. Rest is securities premium. But the question in the exam doesn't tell you the number of shares or face value. So you have to put the total amount in the equity share capital. Okay, because we can't tell the face value. In notes, see there is one more point to tell, and then this accounting will be over. What are the steps you need to follow? In first step, you need to allocate total amount of money you received in compound financial instrument at 0 time. As you said, total proceeds or issue price to financial liability component or equity component. How financial liability component comes? PV of future cash flow in nature of financial liability discounted using market interest rate on similar instruments. How equity component comes? Total proceeds minus financial liability components, balancing figure will come. What's the meaning of nature of financial liabilities in terms of cash flow? If interest amount is mandatory to be paid. After this, redemption amount, if it is redeemable in cash or convertible at option of holder. If it is compulsorily convertible, then redemption amount will not come. If I say there is discretionary interest and redemption in cash, then discretionary interest is the equity component and redemption in cash is financial liability. It's a compound instrument. Discretionary interest is of financial liability nature. Cash flow will not come for PV, but only redemption amount will come in that case. After that, in step 2, I wanted to tell you if there is any transaction cost in such compound instruments. There is one question where it is mentioned. So if there is any other transaction cost in compound financial instrument which is told in question, that you have to incur. So what you have to do, you have to add the transaction cost to the compound financial instrument. You have to adjust it. But this instrument has two components, financial liability and equity. If transaction cost was 1000, then in which component should we adjust it? So this is related to the whole instruments. It will be adjusted in both the components. So you need to adjust in the financial liability and equity component, but in which ratio? In the same ratio as their amounts are calculated in step 1. In step 1, we got the amount of financial liability and amount of equity. Allocate the transaction cost in their ratio. Now record the financial liability and equity after deducting from them. Because transaction cost is debit in nature and liability and equity are credit in nature, your general entry will be in net amount. Bank will be debited total proceeds net of transaction cost, to debenture financial liability component net of transaction cost, or to equity component net of transaction cost. Then step 3, what will you do? You will show financial liability component using ACM approach on every balance sheet date, and equity component will be carried forward at initial value. Step 4, on maturity, if holder converts it into equity shares. Then financial liability and equity component will be closed at carrying amount, issue equity shares at face value and put balancing figure in security premium. If he redeems in cash, then transfer financial liability to bank and eliminate equity component by transferring it to retained earnings. Okay, let's move further. See a note in compound financial instrument related to which we did 2 questions. If there is early redemption or repurchase of instrument before maturity in cash. What is this? For example, if I issued a compound financial instrument, like in above example, it was issued for a period of 3 years. What I did after 2 years, as soon as I got money from somewhere, I said to the debenture holders that I will redeem them today itself. I'm doing early redemption and repurchase of instrument, and if debenture holders also agree, then in that case, how will its accounting be done? The company can choose to do an early redemption or early repurchase of its instrument before maturity. In that case, how will we do its accounting? In that case, how will accounting be done? It's simple. As the first step, figure out the day in books on which I am making an early redemption. On the day of early redemption or early repurchase, how will we know about the carrying amount of financial liability component in my books? We can know that from amortization schedule. And what was the carrying amount of equity component? It should be same as 0 time. Find that out. Step 1 is simple. Look at step 2. If I do early redemption, then I will have to give some consideration from which instrument will be settled, whatever consideration I am paying for early redemption. So you can assume that I am paying consideration for both the liability component and the equity component. Both of these components are being paid by me. It's a simple thing. Assume that today the carrying amount of the financial liability component in my books is 1 lakh and the carrying amount of the equity component is 5,000 rupees. And today I spoke to the people about early repurchase. I told them that I would pay them suppose 1,10,000 rupees. I said total amount I will pay is 1,10,000. They are not aware about equity component or liability component, so I'll pay them that. Tell me why I'm giving 1,10,000? Because I have to finish entire compound financial instrument today. So for whom have I given this 1,10,000 rupees? For both liability as well as equity component. So whatever consideration I'm paying for early redemption or repurchase, you will have to bifurcate it, that how much consideration I have paid for the liability component and for equity component. So first you figure out how much consideration did I pay for the liability component. I gave 1,10,000. How much of that was for the liability component? So for that, look what remains of the remaining future cash flow. What remains of the remaining future cash flow on the day of early redemption? I only had to pay that much extra. Today is 2nd year's end. At the end of the 3rd year, I had to pay 10,000 interest, and I would have had to pay 1 lakh rupees as principal if he had asked for cash. Any remaining future cash flow will be 1,10,000 after a year. Today, if I calculate PV of whatever the market interest rate is, this much amount is generated for financial liability for today. This much consideration I would have given to it. Check that how much more of the remaining future cash flows I would have been paying today if I had not redeemed myself earlier. If I hadn't redeemed myself early, how much future cash flow I had to pay? Today, that is on the day of early redemption. If I look at the current market interest rates by doing their PV, we will get a fair value which will be the component of the remaining financial liability. So this much amount I would be paying today for my financial liability. This will be considered what I would have paid for my financial liability. So how much consideration was paid for equity component? I paid total of 1,10,000. Suppose we get 2,000 rupees after calculating the financial liability, which means 8,000 rupees. Means the remaining amount that I paid in consideration must be for equity. 8,000 is for equity. How it came? Total consideration paid for early redemption minus the consideration paid for financial liability components. Look at the steps and whatever I've written in the notes. Keep this in your mind. I have thoroughly revised it conceptually in class, making sure it's clear to you. Anyone who's watching directly on YouTube, just memorize these notes, and then no matter what question comes up, no question will ever be wrong. Okay? So this is done. Now in step 3, you just need to pass the general entry. We will settle financial liability component first. So to settle debenture financial liability, we need to debit. Deposit whatever carrying amount is due. How much for to bank for financial liability component? What was paid as consideration? Where will that be known? In step 2, you can put that the difference in entry in P&L gain or loss. We need to settle equity component, then debenture equity will fall to carrying amount. To bank, according to step 2, we'll get the amount we paid for the consideration of the equity component. The difference in entry here will be retained earnings. Always keep in mind that whatever equity is, the difference in equity always comes from retained earnings. Okay? Because where does the equity head goes? Equity item goes to other equity, and retained earnings are part of reserves and surplus, which comes under other equity. So whenever transfers happen in equity, the difference gets adjusted through retained earnings. I guess I've been telling you the reason for this in detail under IND AS. Therefore, I don't think it's necessary in this revision video. Now look at the next topic, modification in terms of financial assets. We've seen normal accounting of financial assets and liability. We've seen accounting of compound financial instruments, from where the major questions come in your exams. Now there are many topics further in this chapter from which sometimes questions are asked in exam. Let's see modifications in terms of financial assets. Let's say I have financial asset which can be modified. Suppose I've given money to someone, okay? I've given money to someone on loan for 5 years. I will get 10% interest, and at end of 5 years I'll get principal amount. At end of 3rd year, he came to me and said, I won't be able to pay that much interest over the next 2 years. Please reduce interest a little or extend time period a little. Meaning modification is happening in my financial assets. So how to account for it? Remember these steps. First step is on the day of modification. On that date, find out carrying amount of financial asset in books. How will you find it? Find it out through amortization table. It's easy task. This step itself will get you some marks. In the second step, all you need to find is the revised amount of the financial asset by discounting the revised remaining future cash flow using the original EIR on the modification date. It means that if today is modification date, then look at the remaining future cash flow and find whether I will get the remaining future cash flow or not. Today is the modification date. So today if I made modifications in the financial asset contract, then what remaining future cash flows will I get, and what revised remaining future cash flows will I get? Do its PV with the old EIR. The EIR you're currently showing to financial asset, the logic of old EIR was explained in lecture, that we believe if this contract had been running since 0 time, what would be balance of asset today? What should you do in second step? You revise the remaining future cash flows to PV using the original EIR. Then you will get the amount of financial assets that should be booked in step number 2. Step 1 tells us how much amount is coming in the books, and step 2 of financial assets will tell how much it should be. In step 3, you have to take the difference between the amount of step 1 and step 2, and this will be the gain or loss due to modification, which you will take in P&L. What will be passed as the general entry? If your financial liability is increasing in the difference of step 1 and 2, if your financial asset is increasing, then financial asset to P&L. If financial asset is decreasing, then P&L to financial assets. Suppose carrying amount of financial asset on day of modification was 1 lakh rupees. As per step 2, it should be 1,05,000. So if asset needs to be increased from 5,000, so financial asset to P&L, that's it. After that, look here, I have written a note number 1. If the transaction parties that you have, meaning the financial assets that I have, if there is any special relationship between the parties against me, like employer and employee. So this difference that comes in step 1 and 2, we won't take it into P&L. We'll take it to a special account that would have been created initially. Suppose I'm an employer who gave a loan to his employee for 5 years. On the 3rd year, we modified some terms of the loan, so there was difference in financial assets. So where will I take that difference? At 0 time, I would have put the difference in a special account, prepaid staff cost. The difference that comes now will go to the prepaid staff cost account. After that, note number 2, if I've given loan, meaning it's financial asset for me. So if the other party prepays the loan, suppose the other party had to make the payment in 5 installments, then they would pay 2 lakhs in 5 installments. Person in front had to pay 2 lakhs in 5 installments. At end of third year, he paid third installment and prepaid fourth year installment also. If other party prepays one installment, future cash flows is reduced. Now I'll only get one cash flow as one installment is remaining. Keep in mind that this is also called modification. You have to account for this modification as well when the other person prepays an installment. We had solved a question about a wheel company where the employee prepays an installment. An employee named Mr. X was in that question. Here accounting for modification will be done. Apply steps 1 and step 2. In step 3, when you pass general entry in this case, there will be a twist that you need to keep in mind. One normal thing would be if the other party prepays the installment, then we call it a modification. In this case, the financial asset balance will always decrease. Why? Because the money that was to be received in 5 years, some of it has already been received now. So the asset balance must have decreased, right? When you will get money, assets must be reducing, so financial assets will always reduce. Two financial assets, keep in mind, difference will come for reduced only for step 1 and 2. After this, there will be another item in the entry. It will be a bank debit. Why will it be a debit? Because the other person must have prepaid the installment, so you will also make entry for that. Bank account debited with the amount of prepayment. Where would the difference in entry go? It will go in P&L or in special account if there is relationship. Next topic, modification in terms of financial liability or derecognition of financial liabilities. In this topic, we saw modification of financial assets. Now we'll see that how will we do accounting if there's modification in terms of financial liability. I've added oblique and wrote another name, derecognition of financial liability. If you look at this topic in the module, you'll find it together, and reason is that these are two topics. Modification in terms of financial availability, derecognition of financial liability, which we read at one place. Why do we read it? It will become clear to you soon. Just understand the topic once. You don't need to know the name of the topic. Just focus on how we will solve such scenarios. That is what matters. Firstly, what are the steps you need to follow? Here I've done the working in 2 steps. Just keep these in mind. First, when modification in financial liability, whenever any modification is happening in terms of financial liability, suppose I took a loan for 5 years at 10% interest payable every year. After 5 years, the principal amount is to be repaid. At the end of the third year, if I either change the interest rate up or down or extended the loan, then it will be modification. So for that, first you need to see what is the level of modification, what kind of modification it is. Is it a major modification or a minor modification? It means that we need to find out the level of modification and its percentage. Modification of financial liability is different from financial assets. You have to find out the percentage level of the modification. What is the nature of the modification? You have to find out whether it is big or small. How do we find that out? There is a formula from percentage. It's very simple. Pay attention. PV of revised remaining future cash flow on modification date using original EIR. Today is the modification date, so let's see the revised remaining future cash flows which I will have to pay. Let's discount it from original EIR. It means currently my financial liability should be this much according to new cash flow. What is the financial liability in my books at present? That will be my carrying amount. I have already explained what does carrying amount reflect. If we do the PV of the amount that we have to originally pay in the future, then the amount reflected will be the carrying amount of financial liability. So this is my carrying amount. If I do PV from original EIR of the revised cash flows of the future that I'll have to pay, then what amount will we get? This much amount of liability should be there in books because of modification. How much is this in my book? Carrying amount. What will the difference between these two shows? It shows the amount of modification and how much change it is causing in liability. I wrote PV of revised remaining future cash flows on modification date using original EIR minus carrying amount of financial liability on modification date. Now I have to figure out this in percentage terms. We need to compare, so carrying amount of financial liability on modification date will be divided. Suppose carrying amount is 1 lakh. Upon calculation, the PV of the revised remaining future cash flow using was 1,05,000. It means the liability is increasing by 5,000. I am asking it's increasing on which amount? It's increasing on 1 lakh. Okay. Whenever we have to calculate percentage, we will make carrying amount as base. We got the carrying amount on this in the denominator multiplied by 100. This will give you the percentage of modification. Now here keep one thing in mind, that in the numerator of the formula, I have added fees paid on modification. If I've incurred any legal fees for making the modification that was incurred at the time of modification, it's possible that I may have had to incur some legal fees in the contract. If those expenses incurred, then add to numerator. I want to see the entire impact. I am not doing accounting of modification. I just want to see impact and nature of the modification of financial liability. The more the modification fee, the more we will know that this is a huge modification, right? If there is less modification, then it can be estimated how less the level of modification is. So if anyone has paid the modification fee, even that will be added to the numerator. Understood? So you will get percentage of modification. We got the modification percentage. Now in step 2 we need to analyze this modification percentage and do accounting for it accordingly. If the percentage of modification is 10% or more, what does the IND AS say? That the percentage of modification in financial liability is 10% or more. So imagine that this is a substantial modification, meaning it's a major change on big level. Then in this case you can assume that the old financial liability is over. We have created a new financial liability. You can assume that the old financial liability has ended and we are creating a new financial liability. IND AS says do accounting by assuming it means we've invested new money and exhausted old money. Apply extinguishment accounting. Extinguishment accounting means extinguish means to end something. We are basically ending old financial liability and assuming that we are creating a new liability. Let's understand scenario of 10% and more. Extinguishment accounting is simple. What you should do is derecognize whatever existing financial liability carrying amount there is on modification date. What entry will we make? Financial liability debit for derecognizing carrying amount. Now we need to record the new financial liability. So how do we do that? Whatever is revised remaining future cash flows on modification date, discount it with current market interest rate by calculating its PV. We have already studied that how is a new financial liability recorded at fair value. We have already studied that how to calculate fair value. If it's an off-market term, then calculate its PV based on market interest rate. Whatever revised remaining future cash flows would be there, do its PV. But sometimes market interest rate is not given in question because modification in transaction might have happened on market terms. So in that case, assume that the new financial liability, meaning new terms, the new interest rate that they have are the new market interest rate. In that case, you know what will happen? Principal amount that was pending in present will work as fair value. Because in market terms, the amount received or given at 0 time today's principal which was pending will act as the fair value. We also saw one such question. Or you can also understand it this way, that the interest rate on your new terms of financial liability can be considered as the market interest rate. You can find its PV with revised remaining future cash flow. It will be equal to that amount. Okay, it will be the same amount. You just assume that this interest rate which is according to the new terms is also the market interest rate. How will you record a new financial liability? On modification date, we will PV the revised remaining future cash flows at market rate of interest. The market rate of interest on the modification date is not given in the question. So you can assume that the interest rate under the new terms is the same market rate of interest. After this, if I have to incur any fee for the modification, then paid through bank, it will be noted as to bank entry and new financial liability will be incurred on this amount. Difference in entry among all three items with whatever difference would go to P&L as gain or loss due to modification. This balancing figure is the general entry in front of you. It is a simple accounting of extinguishment. We had solved one such question. This was a question about the wheel company and there were also some 3 or 4 more questions on the extinguishment accounting which we had solved. You might remember it. After that, see if the modification is less than 10%. If the modification is less than 10%, if level of modification is less than 10%, then we'll consider it as normal modification and apply normal modification accounting. So if we talk about what's normal modification accounting, I'll tell you what's the heading of this topic: modification in terms of financial liability oblique derecognition of financial liability. So whenever there was modification, we were checking its level. When the level was high, which accounting did we do? Extinguishment accounting, meaning the existing financial liability was derecognized. For this reason, this topic is also known as derecognition of financial liability. After that, what does normal modification accounting say? For less than 10%, normal modification accounting says don't do anything. You don't have to do anything. You just don't have to change your existing financial liability. Just if you have incurred any modification fees, you can pay it from your existing financial liability. Financial liability debit to bank. Besides this, you shouldn't touch the existing financial liability balance. What you need to do now is just revise remaining future cash flow. These cash flows will change due to modification in the future. At what rate should we find its PV? That the carrying amount of the financial liability in my books today that has happened after the adjustments of transaction cost or after the adjustments of modification fee. So that after paying modification fee, it should be equal to the carrying amount of financial liability. At what rate should we calculate PV of revised remaining future cash flows so that it equals to this amount? So you need to find revised DIR or new EIR, which means we didn't touch the financial liability, but we will find a new EIR so that from this EIR we open this financial liability. So that according to revised cash flow, last closing balance becomes 0. If you have to do this work, then there is less than 10% chance that it will be asked in exam. So it's not very relevant. We also did a question about this. So what will you do? You will pay the fee incurred on modifications by debiting from financial liability, and then you calculate new EIR. Modification date at which PV of revised remaining future cash flow becomes equals to the carrying amount of financial liability after payment of modification fee on modification date. Now see a note on this topic that is on the derecognition of financial liability, which is debt for equity swap. I have taken a loan from the bank, say for 5 years, out of which 2 years have passed. As of today, the amount I owe on this loan according to my books is 1 lakh. Now I am realizing that I don't have enough money to pay the bank. I won't even be able to pay in cash. I've understood that my business won't be able to generate cash now. Bank people knew my situation and realized that I cannot pay them the loan back, and one day I will flee like Vijay Mallya. Then the bank people had a meeting with me, and during the meeting this was discussed. So I said, sir, I will not be able to give you your cash after 5 years. The bank person said, I had already predicted that. The bank official said, what to do now? We cannot waiver the loan. So what I did, I gave the bank an offer. What offer? I said, let's do this. I have to give you 1 lakh today, right? As seen, 1 lakh is the liability carrying amount. You do one thing, get rid of this liability. In exchange, I'll give you ownership in my company. Okay, I'll give you ownership. Then you can run this company according to your wish, and you will have a stake in all the profit and loss. So how can I give away my ownership? By issuing equity instruments, meaning by giving away equity shares. I pitched other party to reduce liability. As I can't give cash, instead I'm offering equity instruments. Debt for equity swap means when an entity is looking to extinguish or settle its financial liabilities by issuing equity instruments. This is called debt for equity swap. Okay, instead of debt, I'm willing to give equity. That's what I'm doing. In this case, accounting is very simple. You debit liability and it's gone. Carrying amount is derecognized. Carrying amount of financial liability extinguished or settled by issuing equity instruments. What have you issued? Equity instrument. Then write to equity instrument. It was at what amount? Fair value. Here we are talking about how to calculate the fair value of the equity instrument. How is it calculated? I am giving equity instrument, so I'll tell them that I am giving 70% stake in my company. So what does it mean to give 70% stake in my company? It means that the other party will get control over 70% of the net assets. So today I will look at the fair value of my company's net assets and then multiply it by the stake I am giving to the other party. This will be the fair value of the specific equity. From that I will record instrument on fair value. Difference in entry will go to P&L, gain or loss. Journal entry for financial liability is on carrying amount debit. To equity will be at fair value and difference in P&L. This topic of yours is completed. Modification in terms of financial liability or derecognition of financial liability, both are covered under the same topic. So we saw the modification of assets and financial liability. If we have seen derecognition of financial liability, then derecognition of assets should also be there, which is our next topic. What does financial assets derecognition mean? Let's say that I have a debtor of rupees 1 lakh. When will it be derecognized? The day debtor pays money, bank to debtor is settled. This is what is derecognition. I have a loan in my books, loan is given, it's my asset. When will it be settled? When we receive money from loan. When will the asset be derecognized? When you receive money normally, and even liability is settled when it's paid normally. So when are the accounting of assets and liabilities settled normally? No topic is made by IND AS to know that. So this IND AS is used to know in some specific cases how to derecognize financial assets. There are specific cases in financial liabilities in which derecognition is shown. Similarly, for financial assets, there are 2 specific cases in which IND AS talks about derecognition. The first specification is the securitization of loan, which we will be discussing now. All of you look here. Now this securitization of loan. What is it? You have learned it already in your lecture, so no need to explain in detail here again. For the rest of you watching on YouTube, if you know, that's good. If not, then there's a chapter SFM where you will learn about securitization and what it is. I will quickly tell you the rest in brief. Let's say I gave a loan to someone in particular. Suppose I am a bank and I gave a loan to someone, okay? I will take his property papers as mortgage in exchange for the loan and give him the loan. I need money today, where will I get it from? What I do is I keep these loan papers as collateral with another entity whose name is SPV, okay? What will I do from that? I will raise money so that my need for money is fulfilled. And what do I promise for this entity in return? I promise that whatever cash flow I receive from my financial assets, which you have loaned me against, I will transfer it to you. Suppose I get 10 installments, I will transfer 8 installments to you. Maybe I will transfer to you all 10 installments that I was about to receive. If I do so, when I get the 10, I'll transfer all 10 of them. That would recognize the entire financial asset. Money I received from SPV will recognize it from the bank. Difference in entry, gain or loss will go to P&L. The ICA, I won't ask such a simple question. It will ask question like this example. I withdrew money from SPV in exchange for a financial asset. When I brought money from bank in exchange, my financial asset was derecognized. How will I show? I told SPV that I was supposed to receive money in 10 installments from my financial asset that's in front of me. I will transfer you 8 installments. Whatever money comes in 8 installments, I will give it to you. I will keep the money for the 2 installments, meaning I have transferred all the financial assets of 8 installments to the other party. So in this case, tell me how much should I derecognize the financial asset? You learn this much is the topic. Here, what do you do in securitization of loan? The entity transfers the right to receive cash flows into a secured loan to SPV. What steps would you follow in this case? To solve a practical question, I have explained the working in 3 steps. The first step you need to do is find out how many components I transferred to the SPV, okay? I have transferred how much component of my financial assets in exchange for the money I received. How much of that has been transferred to the recipient? That is securitized component. Transferred component is referred to as a securitized component in technical terms. Hence, topic is named as securitization of loan. How much of my components have been securitized in my loan? How much of my financial assets have been securitized of my loan? So you will find its fair value. So you can see the total loan I had given here. What's the total fair value of my financial assets? It will be in question. This is the question that we did in detail. You will be given the fair value of the total loan. Take that and subtract the portion that I retained from that total loan. After subtraction, you will get to know that how much amount did I transfer to the other party. Now there will be 2 to 3 things in what I will retain. One will be the principal amount. What I will get from my financial assets, one will be the principal amount. I must have retained some principal portion, subtract its fair value. In technical terms, we call it principal strip. Now I will need to get interest from the counterpart, so I might have retained some interest component, so I will then subtract its fair value. This will also be given in the question. We call it interest strip. After that, there's another thing. I took the loan from SPV in exchange of my financial asset. So I said I'll pay them some installments which will come to me. Tell me when I go to collect the money, my financial assets from the person to whom I have lent money. So it takes effort, it takes time. I may have to call the person many times or might need to send my employee several times. Sometimes you don't get money. It takes both time and money. So I will tell the SPV, look, I will collect the money in 8 installments and will give it to you. Because the person to whom I gave loan, he doesn't know you. Because in exchange for this loan, I am getting money from you. So he doesn't know you. He will give the money, then I will transfer it to you. It will cost me something. That is to say, I am providing a service to you by collecting and transferring the money. I am providing this service. In return, I need a fee, service fee. We call it service asset. So I'll also deduct that value from the total loans fair value which I am requesting from SPV. I'll deduct that too here. Then I'll know how much loan I transferred to the SPV and it's securitized. I will get the fair value of it. This is the first step we need to do. In the second step, what you have to do? You have to derecognize the loan from your books. How much should it be? The amount you have securitized and transferred to SPV. Carrying amount is mentioned in the books and we have calculated based on the fair value. Now you know what to do. You need to derecognize the carrying amount for the sake of securitized component. So you allocate the carrying amount in ratio of fair value to all of these components. Okay. What are the components? How much is securitized component that you transfer to other party? What I said for myself, I saved 3 things for myself. One is principal strip, interest strip and service asset. In these 4 components, I'll allocate carrying amount for the loan from my financial assets according to the ratio of their fair value. What will be the carrying amount of securitized component? Carrying amount of total loan multiplied by fair value of securitized component which we have calculated divided by total fair value of the loan. How much will be carrying amount of principal strip? Carrying amount of total loan multiplied by fair value of principal strip divided by fair value of total loan. Do the same for interest strip and service asset too. Carrying amount is allocated. You just have to make a journal entry. What would the journal entry be? The component that you transferred to the other party first to its accounting. It would be either to financial asset or to loan depending on what you transferred. So component transferred was carrying amount allocated, and in step 2 we found carrying amount of securitized component, enter it. Debit the money received from bank through SPV, difference in entry gain or loss due to derecognition. After this C, let's pass another entry here. We will recognize the portion that we have retained. That loan would be coming as it is, right? We derecognize the loan only to the extent we transferred. But what does the IND AS say? The loan that you retained has 3 components: principal strip, interest strip, and the service asset. You have to write them separately in the balance sheet then. As we show it with different names, you need to classify them separately. Amount will remain same. So finish the remaining loan, enter to loan financial assets, and in return record it separately, the principal strip, interest strip, and service asset. How much will be the amount? You figured out allocated carrying amount in step 2, enter that. So the remaining amount in your loan will be whatever is the total of these 3 allocated carrying amount. The accounting of securitization of loan is finished. It's a simple topic. See the next topic, which is even simpler, factoring of debtors or receivables. See, factoring of debtors or receivables and other specific cases, derecognition of financial assets. I have some debtors in my books. Now I am supposed to receive money from them after 6 months, but I need the money urgently today. So there are some factoring companies in the market that buy debtors and give the money immediately after deducting their fee. If the debtor pays them after 6 months, they will deduct some interest and give you the net amount today. After that, they collect money from that debtor. It's a completely different process from securitization. Securitization is done in a secured loan where I transfer the mortgage papers to an SPV and then receive money. The customer to whom I had given the loan, I collect money from him and transfer it to SPV. But when you do factoring of debtors, there is no security for the debtor. So I sell the entire debtor to any company. I'll call debtor and tell him, from now on you don't have to pay me, but pay that company, I've sold it to them. Then debtor directly communicates with them. This is what happens in factoring. Here you sell debtor or receivables. In this case, it's a very simple accounting. My books have a debtor of rupees 1 lakh. I sold that, so this debtor will be cleared from my books. I will derecognize the debtor at the carrying amount. Finished. After that, what should be the entry? I got money from the factoring company. Yes, so it will be debit to cash or bank. Normally when this entry happens, the difference goes to P&L, but now you have to be careful about, like, it could be that the factoring company said, we'll buy your debtor, the 1 lakh one, in exchange we'll give you 90,000. If they said we can give you 90,000 as our fee will also apply, we'll give after 6 months. They'll give 90,000 after adjusting everything, and I agreed. As conversation ends, here we just make this entry. What happened next? When the factoring company was about to give the check, at that time it was said that, look, I'm giving you the money. Okay, but how reliable is your debtor? I don't know. Factoring company said, if in future this debtor goes default, I ask money from him, he doesn't give. What will I do then? I said, that's also right. Then I told them, do one thing, don't worry. I guarantee you that debtor is my trusted person. I guarantee you if he defaults, I will pay you. But the debtor is for rupees 1 lakh. I guarantee you for rupees 10,000. Suppose if I said so, I guarantee you 10,000. If the other party defaults on the payment, I will cover the loss up to rupees 10,000. I will pay you. So if the other party, let's say, defaulted on 7,000 and then paid 93,000, then I will have to pay 7,000. The debtor defaulted on 10,000. So I have to pay 10,000 to the factoring company. But if the debtor defaults on 20,000, factoring company will get 80,000 from the debtor, and I will give 10,000 because I guaranteed 10,000. So I can also guarantee factoring companies many times. We call it recourse factoring in technical language, recourse factoring. So in this case, another thing will come now. When I give the guarantee to factoring company, it means my liability is possible. There will be liability if there's a guarantee, because if the debtor defaults, then it will be liability. So now I'm thinking, if the debtor defaults, I will have to pay money. Then I will have a right to collect money from that debtor. Imagine a debtor defaults on 10,000. Then I have to pay 10,000 to the factoring company. And then I will have the right to go to this debtor's house, catch hold of him and get 10,000 rupees, which I had to pay to the factoring company because of him. So whenever I guarantee something like this, my books will have another asset which we call continuing involvement in asset. I still have some involvement in this asset. IND AS calls this as continuing involvement asset. We will record it in debit. We record this on which amount? At lower of amount of receivables means what was debtors carrying amount? And what is the guarantee amount that I have given to the factoring company, which I will have to reimburse if the debtor loses to the factoring company, if the debtor loses. In such case, I will record whatever the lower amount is. It's simple. The debtor has 1 lakh. I gave a guarantee of 10,000. So how much will my right on the debtor be? Maximum I can ask for 10,000 because I'm going to pay 10,000. That I'm talking about paying this factoring company on his behalf. So I will book a continuing involvement asset worth 10,000. After that too, when I book the asset, I will also book a liability, right? I booked the asset, I guaranteed due to which I booked the asset. Now I have to book the liability. This asset will only come to me when I will pay the guaranteed amount to the factoring company. It means when my liability can also incur, I'll call this an associated liability. This will be on the amount, the guaranteed amount that I have given to the factoring company. It will be on that amount. That's it. After this, there is one more point. Understand it. When I gave factoring company a guarantee of 10,000, then factoring company handed me a check. Before grabbing the check, now I stopped them. I said, look, sir, you agreed to pay 90,000, but you suddenly changed your mind and asked for a guarantee. Now, will I give a guarantee for free? No, I will not. When I am giving guarantee in return, I might charge some consideration. Example, I might charge rupees 1,000 as consideration charge. I am charging a consideration charge of 1,000. Suppose the other party gives me a net check, it's 91,000. For now, let's say the bank will tell you the net amount you received, the net amount received. Basically, I have 1,000 rupees. It's because I gave guarantee to the other party. Due to this, the factoring company gave me 1,000 rupees extra, gave an extra amount as I guaranteed them. So this is like an unearned income for me. An income that I have received, but I have to provide services against it. So unearned income is a liability. We book it on the credit side and take it to P&L over the period. So now we are priorly recording associated liability in this entry. We'll write another liability separately, unearned income. IND AS said, this is not a normal sale purchase transaction where unearned income is booked as a liability. You are booking associated liability, right? Just add this amount of 1,000 to that. You will enter the guarantee amount in the associated liability and add fair value of the guarantee. Fair value of guarantee means that the consideration I have received from the factoring company is for providing guarantee. It's added in associated liability as it's a type of unearned income in nature. Difference in the entry will go to P&L gain or loss due to derecognition. This will be your journal entry. It was a very simple question. Fair value of guarantee is a kind of consideration that you have received due to the guarantee you gave to factoring company. It's a kind of an earned income. So you record this in the associated liability and over the factoring period you amortize it in the P&L. Next topic, let's see impairment of financial assets. We will learn impairment of financial assets now. See, we are talking about the impairment of financial assets. Sir, is there any impairment for financial liabilities? Impairment does not occur in financial liabilities. Impairment means decrease in the value of an asset. In IND AS 16 we learned PP, intangible assets and investment property. In IND AS 38 and 42. Separate IND AS of impairments is there. IND AS 36 related to those assets where we'll see their impairments. When there are financial assets, their impairment is seen in IND AS 109. This IND AS refers to any financial asset. Say if I've given a loan to someone or I have a debtor, their value can decrease. You'll have to record that as well. How does the value of debtor decrease? There's a very basic example that you have known since childhood. Suppose my books show debtor of rupees 1 lakh to be received after 6 months, but I'm suspecting debtor will not pay me rupees 10,000. I used to create a provision for bad and doubtful debts. That's your impairment. We just call it impairment in technical language. An impairment is a loss allowance for expected credit losses on financial assets. What is the expected loss on your financial assets? Book it. That's your impairment provision for doubtful debts. I have written an example of this. This impairment in financial assets is applicable only when you are showing your financial assets in ACM or FVTOCI. The reason for this is there will never be any impairment on the assets of FVTPL. On the financial assets, why? Because the financial assets of FVTPL are valued at fair value. Fair value is the present value PV of the future cash flows that will be generated by the asset. Fair value is that PV at market rate every day. So that means it's already been considered what he will get from the other party at fair value. There is no need to separately consider impairment as we already considered it at fair value. We'll do it in ACM. As in ACM at 0 time it's shown once at the fair value. Then it continues on carrying amount, charge from the EIR and keep deducting. If there is a financial asset in FVTOCI, then why do you charge an impairment on it? Why should we separately calculate the impairment on it? Because that is also recorded at fair value. Absolutely. But sir, for the FVTOCI asset, why should we calculate the impairment then? I'll tell you that any assets of FVTOCI, we did a question on that too. FVTOCI assets also come on fair value and the entire component of impairment effect will be in it. But again, I mean the impairment loss on the financial assets is recorded in the P&L. Okay, hope you understand. Any fair value gain or loss of assets from FVTOCI, we would have taken that to OCI. So we need to find the impairment amount on such an asset to remove it from the OCI and transfer that amount to P&L as impairment loss. Understand, for example, it was a question based on the same. In my books, there is a financial asset at FVTOCI of 1000 rupees. And today its fair value is supposed to be 950. That means I will debit the OCI account to the financial asset for 50 rupees. Means I'll put 50 rupees in fair value loss. What's given next is in this financial asset there is an impairment of 30 rupees. Its value has fallen for 50 rupees. Why it fell? Because 30 rupees was impairment and the 20 rupees it could be due to the change in market interest rate. So 30 rupees from the 50 rupees that I deposited in the OCI were for the impairment. So that should go to P&L. What we'll do, we'll put 30 rupees under impairment loss, debit P&L. If you remove it from OCI, then 2 fair value loss will be removed from it. Got it? Or you can also make a net entry. The impairment loss of 30 rupees in P&L, fair value loss of OCI 20 rupees to financial asset 50 rupees. The equation was the same as the example we did. We'll apply it on ACM. I have written that any impairment on financial assets will be recorded in the P&L. How the entity records the impairment? The IND AS tells if you see less risk in your financial assets, then you should record the expected credit loss over 12 months as an impairment. Yes? Okay. If the risk seems high, then record the lifetime ECL, which is lifetime expected credit loss. What's 12 months ECL and lifetime ECL? It's very simple. Let's say I've given a loan to someone. It's a 5 years loan. What will I get on this loan? I will get 10 rupees every year and 100 rupees at the end of the 5th year. I don't see much risk in this loan that the money will sink. For the next 12 months, set aside only the amount that will be lost as an impairment loss. I expect a 10 rupees of interest installment in the next 12 months. Okay. I think we will lose 2 rupees here. Book that much as an impairment loss. But if I feel that this loan has a high risk, the person I gave the loan to, the risk of losing money there is high, then the total time period for this loan, its entire lifetime. If it's a 5-year loan, then how much money do you think will be lost during those 5 years? You can book that much money as impairment loss. We call this the lifetime expected credit loss. In the lifetime of this entire financial asset, what is the expected loss? Book it. Every year 2 rupees can sink in the interest, and finally 10 rupees of the principal can sink. Do PV for all and find the amount, as it will sink separately at different times. We did PV and book the found amount as impairment loss. We'll see as per the credit risk. It's not useful from exam point as it's used only in practical life. From exam point of view, it's a very simple question. By mistake, you can get this or else it won't come. So now from exam point of view, how to calculate impairment or loss allowance or expected credit loss, which are all the same. It's simple. For a single financial asset, I have to calculate impairment loss. Example, I have given my financial asset as loan to Mr. A. I have to see how much money can be lost in Mr. A's loan. So take the gross carrying amount, multiply it. If Mr. A does default, how much will he default? Multiply it by that percentage. If 1 lakh is gross carrying amount and if Mr. A defaults, he will default 10% of the amount, which is 10,000 rupees, multiply it by 10. Now multiply it. So what are chances that it will make it default? What are the chances of defaulting? We will call it probability of default and multiply with it. So there is a 5% chance that he will default. 10,000 multiplied by 5%, then book impairment loss of 500 rupees. So you will take carrying amount and see the amount of default done by the other person and take that as percentage. Then multiply chance of default with it and you will get the impairment amount. This is called the probability of default approach. Then look, if we have to calculate impairment for a group of financial assets, meaning for portfolio of financial assets, okay, you can use the provision matrix approach. Generally, where is it used? It is generally used in the case of debtors. Now suppose I have 2000 debtors. Now if I check financial assets of each debtor to see how much impairment is there, it will take a lot of time. So I don't want to follow that method. I want the total group of financial assets, that is total debtors, either 2 or 5,000, all of their impairment loss gets calculated in 10 minutes. So for that, apply the provision matrix approach. You can classify your financial asset on basis of risk. For example, if I have a debtor, then I will see current debtors. So let's say the total debtors are 1 crore and I found out that there are 20 lakhs debtors who have not paid yet. I will ask them to pay. So after this, I saw how many debtors are there from 1 to 30 days past due. Past due means how many days have passed after due date. 1 to 30 days have passed, still debtors have not paid money. 30 to 60 days have passed, still money is not paid. How many debtors are like this? More than 60 days have passed. How many debtors are there like this? Classify them, write their carrying amount. Then apply a particular default rate or loss rate in every category. You will get an impairment amount. Everything will be given in the question. It is a 2-minute question. We have also done it. So the category I had written should be as it is. Students, the categories that I have written, current and 130 past due and 3160 past due and more than 60 days. It can be different. Company can create categories as per their own requirements, right? You will have to do this. You will get the carrying amount. Where will we get default rate from? So the company will check its past experience about how much did the current debtors default in the past. How much did 1 to 30 past due defaulted? How much 31 to 60 defaulted? Based on that, it will figure out an expected rate. So at that rate, it will charge the impairment. How do we get the default or loss rate? It is the PV of the expected loss. You can find out how much loss is possible based on what? On the basis of observed historical sample data divided by gross carrying amount. You will get loss rate in percentage. I have told you why do you charge on FVTOCI. I have written the notes here. Now let's move on to the next topic. So now listen, your next topic is accounting for financial guarantee. We discussed that financial guarantee is a financial liability. You show it on the FVTPL. I told you when we started the revision of this in the AS. Now you will learn how to do the accounting for financial guarantee, okay? Now see, accounting of financial guarantee. Firstly, what is financial guarantee? So financial guarantee means suppose there is a person and he went to bank to take a loan. Bank sent him back because he has neither credibility nor credit rating. Nobody trusts him or wants to give any loan. Now dear children, he needs what? He needs a loan. So suppose he knows me. I could be his friend or even a close relative. Somehow he knows me and he came to me asking for help. He said that I need loan, but bank didn't give me a loan because my credit rating is bad. He was a very close person to me or he was someone I know. So that's why I told him that I don't have money right now, but my credibility is very good in the market. I will call bank and they will give you a loan. So go to the bank and don't worry. Okay, so now I called the bank and told them that I am calling and a particular person will come. Give him the loan. The bank gives him a loan on my guarantee. Then bank says that you gave me guarantee. So I will give him a loan. So this means that I told the bank to give him a loan on my behalf. And if he defaults, I would pay them. I guaranteed them. So then bank agreed for loan. What does this mean? This means that I gave bank financial guarantee. So someone whom I knew wanted a loan. So I gave financial guarantee for that loan. Is this clear, students? I have to do accounting of this guarantee. Why? Because this guarantee is a liability for me, which can come on me. So you have to show this liability on FVTPL. Is that clear? So here in this liability, generally this is normal. Here I have given an example for better understanding. Rest what happens is anyone can give a loan. Bank will never give loan without security. Bank does not give loan to anyone even with some security. Bank will say take it and pay him by yourself. Okay, it's that simple. Now if there is some guarantee, where will it be? So for this, let's imagine there is a company and its credit rating is bad. So it went to the bank and the bank agreed to give them a loan. Bank said that you will be charged an interest rate of 11%. Now if I go to take a loan from the same bank itself, it would give me a loan at a rate of 8%. Why would the same bank give me a loan at 8%? Because my credit rating is very good in the market. So now that company knows me and it found out that I get a loan at 8%. So that company came to request me to give a guarantee to bank on my behalf. So as soon as I say to the bank that give this company a loan at 8%, I will give guarantee that they will give money on time, give him loan at 8% just like me. My relationship with the bank was good. So bank gave them loan at rate of 8%. So this means I have given the same financial guarantee and have to record this financial guarantee. So I have taken an example. I will tell you an example and then we will see it directly in the topic. Now for example, A Limited took a loan of rupees 1 lakhs for 3 years. Interest rate applied on it by bank is 8%. Why? Who have given this loans guarantee? It's B Limited. Suppose I am B Limited. And who am I? I'm holding company of this A Limited. If I'm giving a guarantee, it means I know it. Without knowing, I will not give guarantee. So B Limited is the holding company. I provided a guarantee to the bank. So it was sanctioned at 8% interest rate for 1 lakh rupees for 3 years. Do you know interest rate which would have been applied on A Limited without guarantee? It will be 11%, just like in example. So when will he pay the interest? He will pay it annually to bank and principal at end of the 3rd year. I need to pass the journal entry in the books of B Limited. So in my books, what should I enter? Neither did I take the loan. Neither do I have assets, nor did I lend any money. Only liability I have is the guarantee. So you have to tell accounting of financial guarantee in my books. If POD by A Limited is 2% at the end of 1st year and 6% at end of 2nd year, POD means probability of default. It will come in use later. Ignore it. Now what to do? We are accounting for B Limited. A Limited has a financial liability as they have taken a loan. For bank, it is a financial asset. So here accounting of B Limited is asked. It is a financial guarantee for me. How to do accounting? Indus calls it FVTPL method. Now FVTPL method says at time 0, initially you will record this at fair value. How to calculate fair value of this financial guarantee? Did I get anything at 0 time or pay something? No, nothing. Think about what happened because of this financial guarantee. What happened first? Think that please. Because of this financial guarantee, A Limited gets loan at rate of 8%, which is less than 11%. This means A Limited is getting benefit of 3%. How much is the 3% of 1 lakh? It's 3,000. That is A Limited will get 3,000 every year due to this loan. So this means A Limited will get profit of 9,000. So this is value of guarantee. Due to this guarantee, A Limited will get the benefit. This is the value of the guarantee and this will be its fair value. So now we will calculate this in terms of present value. We will make a table of 6 columns. Okay, now tell me what is the interest rate. If it doesn't give 11% guarantee to them, then he had to pay 11,000 per year. How much will be the interest for him according to 8%? He have to give 8,000. Tell me how much interest savings did A Limited get every year because of my guarantee. It is 3,000 rupees every year, so I calculated directly, but you can calculate it like interest saving to borrower. After that, add in the 5th column the PV factor at interest rate without guarantee if I wouldn't have given guarantee to him. So what interest rate would he get? So now you can PV his saving on that. This amount will come from PV of the interest savings to borrower at rate without guarantee. Do PV from rate of interest without guarantee, because if I wouldn't have given it, then interest rate was 11%. Doing PV will tell fair value of guarantee. Amount is 7332. This is fair value guarantee. Record value 2 financial guarantee. If it's reliability, then it will be 2. It will be credit 2 financial guarantee 7332. So what should I debit? I haven't received any money from the bank. Here we need to understand what should we debit. If I speak normally, the other party's account should be debited. Account of A Limited should be receivable for me because there is guarantee of my liability. If I have to pay the money under guarantee, then I will recover it from A Limited, so debit it to that. So if I would have given guarantee for someone unknown, then I would debit their account. Here who is it? Suppose it's my subsidiary company. For whom have I given the guarantee? A Limited, and I am holding company, that is B Limited. A Limited is my subsidiary. We have a special relationship. What kind of relationship? It's a father-son relationship between us. It's father and son relationship. So I have given guarantee for my son because he was worried and no one was giving him loan at 8%. I told the bank, don't be tensed. It is my son. Give loan to him at 8%. I am giving guarantee on his behalf. I gave guarantee to the bank official, but they said you should have told me earlier. We will give him loan. So they gave it. So I have guaranteed and booked my son's liability, but my son could default. Because he is carefree, he will spend money anywhere and refuse to pay later and ask me to pay. I will have to pay the bank because the liability is booked. Now tell me, what will I receive from the son? He is carefree. What account should I receive from him? Should I make him debtor? Instead of debiting my son's account, I will say that I invested the money on my son. I will assume this is the same as what we saw before. This is a special relationship. So now put it in a special account. So what will it be? Investment in son means the investment in subsidiary. I've already debited it. It's a very simple recognition at 0 time. Understood? Now see what you will do after this. We have read for FVTPL, whatever financial liability comes at every year end, you have to show it at the fair value. This is what FVTPL method means. Financial guarantee is shown on FVTPL. So when first year ends, I have to show it back at fair value. So now what will be the fair value of this financial guarantee at first year end? You will have to find that out. Think, how will you do that? Due to this financial guarantee, 1 year has passed, 2 more years are left. So after 2 years, when the loan will be over, then financial guarantee will also be over. 2 years are left. What should the fair value be today? Now at time 0, what were we doing to calculate the future value of interest on the savings of the borrower? We were calculating the PV. So today when we are calculating fair value at end of first year, let's see savings of borrower in future. 2 more savings have to be done in second and third year, both with interest. So today let's do PV of both savings. So that would be fair value. So you will do PV of saving of remaining interest, which will be at end of second and third year. But one thing to keep in mind is it's first year end today, and how far is it from second year? 1 year away. And third year is 2 years away. It means just take normal PV factor of 2 years. Do PV with without guarantee rate 11%. I have told you repeatedly, keep this in mind while doing PV. The amount is 513.9. So this is the fair value, but you have to keep a little caution here. Whenever you calculate fair value of a financial guarantee at each balance sheet date, you will compute the present value of remaining interest savings. We will do one more task and then we will see the fair value. What is the task? Listen to me, now we need to find. At 0 time, I had already given guarantee for my son. Okay, for once I got everything recorded. But after a year passed, I understood my son's actions, that my son took a loan for his pleasure. He spent the money on his pleasures, and I think he will not be able to pay the amount. I think that my son will default on some of the bank's money. Because as the time passes, you will get to know more about your son's behavior. So the one you guaranteed on your behalf, you will realize how much he can default by looking at his actions. So at end of first year, I realized probability of default. A limited is 2%, meaning my son A limited will do default of 2%. I have understood this from his behavior. So 2% of 1 lakh is 2000. I think he will default 2000 rupees. So you can find out expected loss amount for 1 year end by A limited, which is loan amount multiplied by probability of default. So 2000 rupees. So tell me how much financial guarantee should we record if we think logically? So the PV. But if you think about it a little more in detail, guarantee means amount I might have to pay for. So I can see expected loss of 2000 rupees by A limited. So I might have to pay 2000 rupees. So record it. At first year end, fair value should be 5139 rupees PV of remaining interest saving, or expected loss should be rupees 2000. IND AS said to take a conservative approach, whichever amount is higher of liability between these two. Consider that fair value of liability, fair value of financial guarantee. 5139 is the highest. That means this is fair value. On books, what is the financial guarantee at 0 time? It's recorded at 7332. 7332 is recorded at fair value. What should have been there? 5139, which means your fair value is decreasing. Decreasing in fair value of financial guarantee is 7332 minus 5139, which means 2193. After that, see what will you do for general entry at first year end. Financial guarantee will decrease to 2193 divided by 2, PNL 2193. So it will be transferred to the PNL. After that, fair value of financial guarantee at second year end, we will do same. At second year end, which interest saving will be left? Only the third year. Do its PV, it will happen after 1 year. And then expected loss. So second year end, look at expected loss. It is given 6% probability of default for second year end. 6% of 1 lakh is 6000. What would be fair value at end of second year? PV of remaining interest saving is 2703. And now the expected loss is 6000. The higher amount is 6000. So it would be my fair value in the second year for the financial liability. 6000 is fair value. How much is in books? So think about the fair value last time. Last time we had calculated fair value 5139. So then too we had brought financial guarantee to the books. How much should it be at end of second year? 6000, meaning it should increase. 6000 minus 5139. So increase by 861 to financial guarantee in debit PNL. Just invest in selling at 0 time. Later on you'll carry profit and loss in PNL because at 0 time we are investing on son. But when at the end of the year we learned that the son is carefree, there will be no investment. It will either be loss or profit because of son. There will be one thing only. There is no profit of investing in my son. Okay, so your gain and loss will go in PNL. After this, general entry is at third year end. See what will happen. It is third year end. The day for loan to end has arrived. Today we will know if son will be able to repay the loan or not. Here son means the borrower, which is A limited. If he does not default in loans, liability is over. So close the entire financial guarantee. It's gain because of son. The whole 6000 gain will go to PNL. Investment on son gave profit. So that profit will go in PNL. So loss on gain, it will go in PNL. And if the borrower, that is A limited company, defaults on its payment, then what will happen? How much is default amount? So for instance, if it is 1 lakh, then 10% interest rate on amount. So 10,000 rupees, if he doesn't pay that, then I will have to pay that to the bank. So finish financial guarantee as it is coming 6,000 in the books, to bank 10,000, and the difference in entry in P&L. So 4,000 balancing figure is gone. So this will be accounting of financial guarantee. Read the notes, I will show them. See step 1, financial guarantee. What will entity do initially? Financial guarantee. Because financial ability will record for you the present value of interest saving to borrower over the period discount using interest rate without any guarantee. Same amount will be debited as receivable from the borrower or a special account if a special relationship exists. PV of interest saving is taken out by making table of 6 columns. I have noted it. What is your second step? At end of every year, we need to show financial guarantee at fair value. Because of FVTPL, find fair value that is higher of PV of remaining interest savings to borrower or expected loss due to default by borrower. Formula of expected loss is loan amount taken by borrower into probability of default by borrower. In step 3, take difference. In step 2, take fair value, which was calculated what is previously recorded amount. Its fair value gain loss, which will go to P&L. After this, in step 4, borrowings will mature. So if borrower hasn't defaulted, then terminate it and put it in P&L. If borrower has, then financial guarantee needs to be terminated. You made payment because of default and rest will be in P&L. Now next topic. Let's see the next topic, that is accounting for derivative contracts. We had seen in the beginning that there is something called a derivative contract. So it can be financial asset if it is potentially favorable. If not, it can be financial liability. How will we do accounting of derivative contract? Firstly, we need to know what is derivative contract. You will learn about it in detail in SFM, okay? I had told you about this in the lecture as well, but I still discussed some basics that you should know to do questions related to this topic. If you haven't studied derivatives in SFM, we'll look at how to do valuation, how the valuation happens. We will learn all this in derivatives in this chapter in SFM. In FR in IND AS 109, we'll learn about accounting of that derivative contract, how it will be done as per IND AS. So first understand what is derivative contract. It is a contract between two parties for the purchase or sale of an underlying asset. On a certain future date for a certain price. What does that mean? Please understand. I am Mr. A and there is Mr. B. We both are very close friends, and one day we went out for dinner and we just started talking that price of Reliance share will fall or rise. Right? So today in market Reliance shares are at 2,000 rupees. Now I feel that Reliance shares price will rise, that's what I think. But Mr. B says price will fall, I say price will rise, and he says price will fall. So between us, this became quite controversial, so we decided that let's make a bet, let's do some betting. Let's bet. I said the price will go up and he said the price will fall. So what happened now? Betting went in a way that I said we'll see if price will fall or rise. Today the price is 2,000. And I feel the price will go up. Let's do one thing, 6 months later, whether the price will go up or fall. So 6 months later, I'll buy Reliance shares. I will buy that share for 2,000 rupees at today's price only. You think price will go down, right? You'll make profit. I'll buy it from you for 2,000. You buy it from the market for cheaper price and sell it to me for 2,000. As you think price will go down. And I think the price will go up, so I will buy it for 2,000. And then I will sell it in the market after 6 months for higher price. So we both are thinking today that we will make profit by doing this contract. So this is a derivative contract. We are speculating on Reliance share prices, okay? I have made a contract to buy Reliance shares for 2,000 rupees after 6 months. The contract is about buying a specific Reliance share. It's a purchase contract for me and a sale contract for him. Is purchase or sale happening today? No, after 6 months on fixed future date. A certain price has been decided, 2,000. Now on that day, even if shares are for 2 lakhs rupees in the market, I will still buy it for 2,000. Sell this, there is no other choice. It will be huge loss for him, profit for me. These are derivative contracts. Underlying asset can be shares, currency or anything else. Now let's look at some examples of derivative contracts such as forward contracts, future contracts and option contracts. See inside this, there are many types over here as well, but whichever are useful here, I have noted down here. Like the forward contract, like Mr. A and Mr. B, this happened between us. We both sat at a table and talked to each other normally. A future contract is similar to a forward, but it involves an intermediary, the stock exchange. Two parties go to the stock exchange and make a contract there. Two parties don't know each other, they just know the stock exchange intermediary. And in stock exchange, only net cash is settled. That means at maturity, you will only get net cash settlement. I'll tell you that later. There is an option contract. It has two options, call option and put option. If I'm a buyer and I have bought an option, and if I have bought a call option, then I have the right to buy. And the one who has sold the call option is called the option seller or option writer. He will have the obligation to sell. But if I have a put option and have bought it, then what I get right to sell, and the option seller has the obligation to buy. I didn't note the details here because it's not relevant here. It's relevant in SFM, so we'll see there. So we did not go into detail because if we did, 2 lectures would just be spent on it unnecessarily. There is no need for that here because that topic is already covered in your CA final in SFM. Now you see a derivative contract doesn't have its own value. It derives its value from the underlying asset. For underlying asset, we do contract. I have entered in contract to buy Reliance share from you for 2,000 rupees in 6 months, made the contract on piece of paper, and we both have signed it. So it becomes a derivative contract. This piece of paper itself has no value. A piece of paper is only worth maybe half a rupee or 2 rupees. Its value depends on the underlying asset. It has no value of its own. Suppose 3 months from today on 31st March, the contract is not settled yet. It will be settled after 6 months. The price of Reliance share will be 2,300 in market. What was the contract? I will buy it for 2,000. Who will be happy? I will be happy. I had committed for purchasing in 2,000. Now if price continues to increase, it will benefit me. If I will buy it in 2,000, then I will sell it for 2,300 and get the profit of 300. I will only pray to God that please continue this price or increase it further. If Mr. B was seeing the price in market today, he must be crying. If he thinks that price reaches up to 2,300 on the date of maturity, then he has to buy it from market in 2,300 and sell it to me in 2,000. There will be loss of 300. So derivative contract, all this happened because of this piece of paper. This piece of paper has a value of 300 rupees. So one person is getting 300 rupees and one is losing 300. So after this, in derivative contracts, you either don't need any initial investment at 0 time, or it is required for a very small amount. We both made a bet and signed a contract. That's it. Did we need money in 0 time? We did not need any money, right? But it could happen that for the contract, he would ask me to pay rupees 10 while signing the contract. He said, Mr. B told me, if you give me 10 rupees, I am ready to make a contract with you. To enter this derivative contract, I had to pay 10 rupees. This can be called as cost or premium paid for the derivative contract, which is generally what you pay in option contract. And this amount that occurs is a very small amount if it occurs. Otherwise, we don't have to pay any amount. So we say that in derivative contracts, initially you either don't need any investment or you need a very little amount. Now let's learn the settlement of derivative contract. The contract matured and let's say the maturity price was 2,300 for the share price. So now he will buy it back from the market at 2,300 and sell it back to me at 2,000. I'll buy it for 2,000 and sell for 2,300. He bought it for 2,300 and sell it at 2,000. So he will suffer a loss of 300 and I will get a profit of 300. Ultimately, we did not care about Reliance shares, but we care about profit or loss. So I made a profit of 300 rupees and he suffered a loss. Instead of going through a long process, I gave him an option. I said him, why will you buy it first, then sell it to me, then I will sell it further. Ultimately, I am losing 300 and I am gaining 300. Do one thing, just give me 300 rupees directly in cash. That's it. Derivative contract can be settled in net cash also. Can be taken with physical delivery or net cash. It is either of forward or option nature, means it is option or forward contract. It can also be settled in physical delivery or in net cash. We will assume physical delivery here from an exam point of view. But if it's a future contract, meaning that happens through stock exchange, it never makes a physical delivery in a future contract. Instead, they settle it through net cash. If it is future contract, it is settled in net cash. We need to see how the accounting for derivative contract is done. It's very simple. Derivative contract potentially favorable for the entity. If it is so, then the derivative financial assets will be created. If it's potentially unfavorable, it will be a derivative financial liability. How do we measure it? With FVTPL approach. So in FVTPL means fair value. In derivative contract, you should understand when you need it and for which periods. So one is to recognize initially. So sir, the initial recognition, meaning the day the contract was made, tell me on that day what is the value of this derivative contract. Today I have a Reliance share of 2,000 rupees. If value increases, I win. If it drops, he wins. So So if the value increases to 2000, my profit will decrease. I've already signed the contract to buy at 2000, which is 6 months later. So if I say today the fair value of a derivative contract is generally 0. At initial recognition, the fair value of a derivative contract is 0. Does this piece of paper have any value today? Today the share is 2000 and we're talking about buying it. So generally today we have a 0 value. We get a 0 value in all these questions. And we can't enter anything in the initial recognition on the first day because there is no value. What happens at 0 time? If I have paid any cost or premium to enter into a derivative contract at 0 time, so I will consider that amount as the fair value, which will be potentially favorable for me in a way if I will pay the amount to bank. Suppose I paid 500 rupees to enter into this contract, so to bank 500. Now what should I debit? Assets are there in debit, so do derivative financial asset in debit. So if you have paid any cost or premium at 0 time, we'll consider it as a fair value and that will be potentially favorable in nature, okay? After that, in the FVTPL, when do you need fair value? On every balance sheet date, so you will come on the balance sheet date. So today is 1st January and I said after 6 months I'll buy Reliance share from you for 2000. So after 6 months is 30th June. Now balance sheet date 31st March came in between. Suppose on January 1st I didn't pay any premium, only 0 amount, so there won't be any entry. 31st March balance sheet date has come. So I need to check derivatives fair value of today. There is a simple method of checking it. The value of a derivative depends on the value of its underlying asset on the day the contract is made. Check today's price of underlying assets in the market means the price on the balance sheet date. Today suppose the market was at 2200 and I bought a contract for how much price? At 2000 rupees. The market is at 2200 now. Tell me, what do I see now? The price has increased, so I'll buy at 2000 and sell it at 2200 and I will make a profit of 200. It seems potentially favorable. Profit is visible. Will it occur today? No. It will happen on 30th June. It is potential. There is no guarantee market can move in any direction. Today there was no profit, but it might be in future. Potentially favorable means I can see derivatives financial assets of 200. Book the derivative financial asset to bank today 200. This will be entered on your balance sheet date. How we did it? As today 200 came in fair value, nothing was recorded at 0 time, but at 200 directly. Let's suppose there is another balance sheet date in between. For once I'm assuming that 30th April is also my balance sheet date, though it doesn't usually happen this way, but I'm assuming this. Suppose on this day the market price of the share goes up to 2300 rupees. Today what I see, I contracted at 2000 and value reached at 2300. So the price of share is 2300, means fair value of this paper is 300 rupees. I have compared the price of this paper on contract date and today, so the fair value of this paper is 300 rupees. What fair value has been recorded in books? 200. What it should be potentially favorable? 300, means derivative financial asset book at 100. So do accounting in this way. It's very simple. Now what Mr. B will do, he will book DFL, derivative financial liability. So the difference between the price of the underlying asset on contract date and balance sheet date will be the same as the fair value of that derivative on the balance sheet date. There's another point to note. If the yield rate is given in the question, meaning there is discounting rate given for PV. So in that case, calculate PV from the fair value. Suppose contract is on 30 June, today is 31st March. What's fair value? 200 rupees. Now you have a yield rate. Will this benefit today? No, it will occur on 30th June, so there is still time. That means you should also consider the time value of money. Means if there is any discounting rate, so send its effect. Get the PV done calculating it from the 3 months today. We had a similar question related to hedge accounting. We did it in that and it's the same as the accounting for derivatives. That's fine. Later we'll look at the topic. So we did that if it was given. So we'll take potential in every year and it is favorable, DFA to P&L, and potentially unfavorable. So P&L to DFL. The settlement day is here now. What to do on that day if the settlement is in physical delivery, means option contract or forward contract is there. So I purchased the underlying asset in the contract. What happened? Today I will get the underlying asset. Okay, we bought Reliance shares. Now that will be debited as an asset on what amount? On its fair value of that share. Suppose it's 2300 fair value in market. I got share of 2300 debit. How much amount gone to bank? Initially contracted amount 2000. And DFL or DFA, whatever I may have booked by this day, I will finish it. If it's DFA, then credit, and if it's DFL, then debit. The difference in entry will go to P&L. I made contract of sale according to perspective of Mr. B. He will get money from bank, initially contracted amount 2000. The asset will go at fair value. What amount of share will go to underlying asset? 2300 rupees. The accounting was simple. And after this we'll finish DFE, DFL and difference in entry in P&L. If there's a future contract, it is settled from net cash. What will you do on maturity? On maturity date, how much carrying amount in the DFA, DFL should have arrived equal to its fair value of today. So if there is a gain, then it will be received from the bank to DFA. It would have become DFA, and if there is loss in settlement, then it would have become DFL to bank at same amount. This was done in Hedge accounting question. Now Hedge accounting. What is hedge accounting? Derivative contracts that you make are made by three types of people as seen in SFM: speculators, arbitrators and hedgers. Speculators and arbitrators enter the market to make profit. They only want to make profit. Hedgers are those who have an existing risks and poor guys want to reduce them. They want to hedge. Hedging means reducing their existing risks. That's why they enter into derivative contracts. So if a person is entering into a derivative contract for hedging purpose, he can apply hedge accounting. The IND AS provides the option. Hedge accounting is not mandatory, and that's why this topic is not relevant from exam point of view. Hedge accounting is not mandatory. The entity has choice to apply hedge accounting in India according to IND AS. In hedge accounting, you have to see it in three ways according to IND AS 109. First is cash flow hedge. Okay, now you all can see the first one is your cash flow. We have a question about it also, so we did that question. And if there are chances of these questions to come in exam, by mistake, if it does come, then also only that question will come about cash flow hedge. Okay. So what is a cash flow hedge? In this, you do this hedging because you want to protect your future cash flows that you are going to receive in the future. Suppose I said I have a deal for a sale in 6 months. In that sale, I will be getting $3,000 from America. As I am from India, I don't need dollars, I want rupees. I am afraid that the dollar rate will fall after 6 months. It is 75 today. I am scared, so I went to the bank and made a forward contract that, sir, I will sell you this dollar in 75 rupees after 6 months, no matter what the rate is there in the market. I did the derivative contract, the forward contract, dollar underlying asset to sell 6 months later at the rate of 75. Why did I do that? Because I want to avoid this particular risk that the dollar rate falls in 6 months on forward. I want to avoid this risk. The sale money which will come, the foreign currency money I will get. To protect myself from that risk, I am doing this, means I am protecting my cash flow, means hedging cash flow. In this case, what is hedge item in this example? Sale of goods. That is the item which I have hedged. The accounting for that, do that according to the respective IND AS provisions which apply here. IND AS 115 applies to sale of goods according to the normal accounting. What is hedging instrument? Forward or future contract, whatever I have done. What is the accounting for it? The derivative contract accounting which we learned, we will do the same. One thing will be different. Where do we take the fair value gain and loss that comes in derivative in P&L? In this case, you will take fair value gain or loss to the cash flow hedge reserve, which goes to OCI. Gain or loss will go in cash flow hedge reserve on the every balance sheet date. So will it stay there for whole life in this case? No, it won't. So the day that hedge items transaction is recorded in books for sale of goods, on that day balance of cash flow hedge reserve OCIs will be calculated and put into P&L. Since the transaction has been completed, there is no need for it. Simply enter gain or loss in P&L statement. Understood? The accounting is very simple. After that, the next thing is fair value hedge. In this, you do hedging to protect the fair value of the particular item. Okay, let's say I have invested in a company's debentures which are also listed in the market. If I am afraid that in a year its fair value will drop, then to protect it from that, I have hedged against it. Its value has been protected by hedging. This is fair value hedge. Here what you need to do is the hedge item that you have protected, you need to show it according to its respective IND AS. Just keep in mind that they wanted to protect the fair value of that particular item, so there must be differences in fair value there. The fair value gain loss should always be shown to you in P&L, no matter what respective IND AS says. I am showing investment in debentures on FVTOCI. So where am I taking the fair value gain and loss? I am taking it to OCI. I am showing investments in debenture in FVTOCI. For this I have done the hedging to protect its fair value. So now I have to show it according to IND AS 109. Fair value gain or loss, whatever will come, I'll take it to P&L even if it's classified under FVTOCI. It's a useless point, but remember it. After this, the hedging instrument, means through which I am doing its hedging, which is derivative. Yes, I am doing it through an hedging instrument, alright. Its accounting is the same as the derivative contract with all gains and losses in P&L, nothing any different. Next is hedge of net investment in foreign operations. You have some foreign operations. Suppose a company in India has a branch, a subsidy over there. It is in the US, so it must be doing transactions in the US. I am going to sell it in future. I will sell the contract in the future. The sale contract is already made. I will get a foreign currency. If I get foreign currency later, I am afraid that the receipt for foreign currency, when I convert it to my own currency, the dollar rate will fall and I will get less money. I'm just protecting the cash flow, but with a specific nature. What is the nature? Receipt in foreign currency of sale of foreign operation by entity. So this is called a hedge of net investment in foreign operations, and its accounting is the same as cash flow hedge reserve because it serves to protect the cash flow. Okay, now let's move on to the next topic, embedded derivatives. See, this is a very easy topic. Some students are afraid of it, but this is a very simple topic. When we taught it in the lecture, we easily did it. What is this embedded derivative? I have a normal contract. I have made a normal contract for anything. I have made a normal contract for anything and I have added the flavor of derivative to it. Added a derivative to it, attached the derivative, embedded it. Embed means to add, attach. This is called embedded derivative, adding the flavor of derivative to a normal contract. So what will we call a normal contract? In technical language, we will call that normal contract as host contract, in which the flavor of derivative is added. What could that host contract be? The host contract as per this IND AS could be either financial liability or some non-financial item. Non-financial items mean anything other than financial assets or financial liabilities. It could be a financial liability or a non-financial item, but not a financial asset. It is not needed here. I will tell you what is the use of this topic. For this you will have to take an example, so I will tell you through an example. See, I will give you an example of this according to what we saw in IND AS 116. We have seen such a portion in IND AS 116 with embedded derivative, but it was not discussed by this name because there was no need for this thing. I will remind you, see, I have taken an asset on the lease for 5 years, its lease payment was due, and what the other party said about this was, okay, you pay one like every year for this, but also every year whatever the inflation rate in the market will be, the lease payment will increase due to that. I had made a normal lease contract which had lease liability. I had to make lease payments in the future. I have explained lease liability, which is a financial liability, a contractual obligation to pay cash. For its accounting in AS 116 is there, so we apply that. In balance sheet classification it goes in financial liability. So on the lease liability, let's say I have taken an asset on lease. For that, future payment is around 1 lakh as per the normal contract. As soon as the lessor said that the payment will increase every year as per the inflation in the market, that means in the normal contract I have added a flavor of derivatives. So what will be the inflation rate in the market after 1 year? According to that, the lease payments will increase. So the inflation rate is an underlying asset. Okay, the inflation rate is underlying asset. We will take the inflation rate 1 year from now. As per that, it will increase. It has been decided today. So that is a derivative portion. I didn't make a separate contract for derivatives. I put the flavors of derivatives in a normal contract known as embedded derivatives. What is the need of this topic? What will this topic teach? This topic just talks about one thing. What is it? The normal contract we made and the derivative that was added in it. So should I remove the derivative portion from this contract and separate it, or should I keep normal contract separate? I will do separate accounting of normal contracts and separate accounting of derivatives, or should I add the derivative portion to the same and allow the normal accounting of this contract to go on? If you remember the IND AS of lease, when we were recording lease liability, then we didn't pay much attention. We didn't think about derivatives there, but we made some adjustments. For inflation rate, which is a different thing, but we hadn't learned anything about derivatives then. We were treating it as normal contract and not separating the portion related to the derivative and applying derivative accounting. We learned derivative accounting in 109. There it was treated like a normal contract. So when should it be separated or considered part of the normal contract to which it is attached, and its accounting should be done accordingly? This topic will discuss that. Here we discuss that a normal contract, host contract, can be a financial liability. Suppose I have taken a loan from bank, a financial liability, add a derivative flavor in this. Also, there can be a contract for any non-financial item, like I have made a contract to purchase or sell goods in a normal ordinary course. PP purchase sales contract, which is a normal host contract for a non-financial item. If I add the flavor of derivatives to these, then this index tells you some accounting in that contract. Should we separate it or not? If we separate it, then how will we do the accounting? And if not, then how will we do the accounting? If we don't separate it, then there is no role of this index. If we don't separate, then whichever host contract covers the respective IND AS, just apply accounting for that host contract and forget the derivative, as we did in case of lease. Now look here, when to separate it and when not to separate it. You have to learn that host contract and derivatives that you embedded in the host contract, you should separate them when they were not closely related to each other. Understood? If the host contract and the derivatives that you have embedded in it, which has the flavor of the derivatives, need to be separated if they both are not closely related. If those two are closely related, the host contract and the derivative, if these two are closely related, then don't separate them. Let them stay together. Apply the accounting of normal host contract. Okay. If the host contract and the derivative which is embedded in it, if they are not closely related, then separate them. Now closely related, not closely related. What does this mean? So try to understand with an example. Closely related means close relation, host contract and derivative. These two things have a very close relation. So don't separate them if they are two people very close to each other. Why to separate them forcefully? Let them be together. But if there are two people who are not very closely related, then you should separate them, right? Separate them if they are not closely related. So what does this IND AS say to closely related? It means a general practice in such markets. Closely related means that such things happens in the market, right? Such things happens in the market. That means generally if it doesn't happen in the market, but if this host contract are mixed with these derivatives, then separate them. But generally in the market, it happens that derivative is mixed with the host contract. Then don't separate them, they are closely related. If such things happens in market generally, so they are closely related, don't separate them. So as I gave you an example in the lecture, you know that there are two people. One is this and one is this person. These two persons were expected to join each other. Everyone know that, the whole world know, the whole market know that. So when the both of them came together, it is not a big deal for you because it was a market practice. It was already decided, it's a general practice. These two were meant to be together. So you should not separate them now. Anyway, you can't separate them. Okay, but you see this person and this is another one, okay? These two could never be together according to you. This could never happen, and the day they came together, it was a shocking news for you. How can these two be together? How it is possible? So such shocking news came and then you said, how are these two together? They should be separated. This can't happen. We should separate them. So when something shocks you, something that makes you wonder how it's even possible, something that's not a common practice in the market, you need to separate it. Separate those two things. They came together by mistake. Separate them. If they are not closely related, then you can separate them. If they are closely related, then don't separate, apply host contract accounting. And when they are not closely related, then here the role of IND AS will come, the role of this topic will come. What would you do in the case of not closely related? Separate the host contract and whatever IND AS is required for that, apply its accounting. And the derivative portion, apply the derivative accounting on it, which you have already learned. Now here, see, there can be many examples. In how many cases can we look? See, there can be many examples. IND AS only considers two examples, two specific cases where derivative is embedded in host contract. There can be many examples, but we need to study two specific cases. Question in exam will be from these two cases only. And these two specific cases are such that they are generally not closely related in the market. It could also be closely related, but generally there are two cases where things that are not closely related can come. Otherwise, wherever an embedded derivative will be inserted, if it is a generally closely related case, so there will be no need to separate it. In two cases, the first is a prepayment option in a loan taken from a bank. I took a loan from the bank. So taking loan from that bank is financial liability. It means host contract can be financial liability. I took a 5 years bank loan. I will repay after 5 years and every year I will pay interest of 10%. That was the agreement. But I also took an option from my bank. That bank manager, listen, I might receive the money in 3 years. If I can, please give me the opportunity to prepay the loan on that day. The banker said, okay, if you get the money after 3 years, then you can prepay and finish the loan even after 3 years. I included this option, means I added a prepayment option to a normal loan contract, like adding a derivative flavor to a normal host contract. Host contract loan was taken from a bank is a financial liability, and prepayment option is an embedded derivative in this case. Now here you have to see if this prepayment option and the loan taken from a bank, if it's closely related, then don't separate. If they are not closely related, separate them and do separate accounting. When will they not be separated? If I say generally, in the market this practice is common, it's not surprising that the bank given prepayment option. If you are taking a loan from the bank, then there is a prepayment options. It's not a new thing, so it's generally closely related. But what was said here, not closely related, when will this happen? When the prepayment amount which I can use to finish this loan, that amount is not approximately equal to the carrying amount of loan taken from the bank on prepayment option exercise date. The day when I can make a prepayment means the third year end, whatever carrying amount will be in my books for this financial liability. That amount should be approximately equivalent, if not exactly equal, to the prepayment amount, whatever it is. So you can assume that it's not closely related. Its complete logic was given in the lecture with examples. I'll show you quickly and tell you. If you understand it, then it is good. Otherwise, keep it in mind. I don't think we have time for giving logic in the revision lecture, but still I will tell you. See, I said one more thing. The host contract can be a financial liability or a non-financial item. If host contract is a financial asset, if it's financial asset and there is a derivative portion in it, then you don't have to do anything different. Just use the normal financial asset accounting. You don't need to overthink. So financial liability or non-financial liability is the host contract. So you have to check if the need to be separated. That's the reason. Okay, now I will explain to you about the prepayment option. I will look for an example that I explained in class. See, I had written an example here for you. Remember, right now it's like that, but try to understand 10 rupees, 10 rupees, 10 rupees, 10 rupees, 10 rupees. So I have to pay every year for 5 years, and at the end of the 5th year, I have to pay 100 rupees principal amount. That's pre-decided. After that, what happened? I took a prepayment option from the bank. What prepayment option did I take? That in the second year. If I want, I can prepay this loan. If I want, then I can prepay this loan at the end of the second year. I took an option that at the end of the second year, I will prepay this loan and finish it at how much amount? By paying 112 rupees. What option did the bank give? Pay 112 rupees at the second year and then they will finish the loan. I got this option. So now see whether this prepayment amount is equals to carrying amount of my financial liability amount at the end of the second year. If it's equal, it's closely related. If not, it's not closely related. Separate it. Now, why are you looking at equality in carrying amount at the end of second year? Tell me how much more payment do I have to make at the end of the second year if I don't prepay the financial liability? 10 rupees in third year, 10 in fourth year, 10 in fifth year and 100. That means I have to pay total 130 rupees. I have to pay 130 rupees more. So that means these 130 will go into the future. Means this is my liability. Should I PV it? Then I should give this much amount to the bank today to settle the loan. In future, I need to pay the bank rupees 130 more after calculating its present value. If I pay this balance, then the loan should be settled. Yes, definitely. So what I call this 130 rupees the carrying amount of the financial liability as of today. What is carrying amount? It's the present value of what you are going to pay in future. So suppose it is 110 rupees. So that is 110 rupees the carrying amount for financial liability for the second year, and the prepayment amount is 112 rupees. Tell me, are these equal? No, so can we say they are not closely related? If it is equal, then it is closely related, and if it is not equal, then it is not. Separate them because it is not general practice. Generally, the loan should be closed by paying the amount equal to the liability, right? By paying the amount equal to the liability, but here I have to pay 112 and my liability is 110. So IND AS said, look, generally it happens. So you can assume that when it is the same amount, then it is closely related. But same amount doesn't mean exactly the same amount. If it's approximately equal, we will assume it as closely related. If it's not approximately equal, that means 112 rupees and 110 rupees. Approximately they are not equal. So you can assume they are not closely related, then separate them. So 110 rupees and 112 rupees. What's the meaning of approximately? Approximately, company will make its financial policy and will disclose it in financial statement. What is the meaning of approximate? Suppose the company has said that for differences greater than 2%, means for differences up to 2%, we consider them to be approximately equal. See 110 rupees. What is the 2% of 110? The carrying amount 110, so it is 2.2. And at 112, I have the right to end it, which is 2 divided by 110 multiplied by 100, this amount. So the difference is 1.82%, and for me it's approx equal to 2%, which means approximately 110 and 112 rupees. 110 and 112 rupees are approximately equal for me, so they are closely related. Don't separate. If the bank said 115 instead of 112, so the difference would be 5 divided by 110 into 100, means 4.55%. For my company, an amount up to 2% is approximately equal. We don't consider anything more than that as equal. So 4.55% means it's not equal, meaning not closely related. Separate it, that's it. That's your topic. That's all you need to see. This prepayment option is closely related when it will not be there, when prepayment amount is not approximately equal to the carrying amount on prepayment option exercise date. Now this isn't very useful, so let's move on to the next, sell and purchase of goods, PP, etc. in foreign currency. Next, I have made a contract to sell or purchase goods. I have made a contract to sell or purchase goods. I will sell the goods after 6 months in ordinary course. It's a normal transaction and non-financial. Okay, but in this contract I have talked about doing the transaction in foreign currency, that I will sell goods in foreign currency. So in this case, meaning this foreign currency flavor, this would be embedded derivative. Now how this happens, let's understand this by an example. This won't work without an example. Let me explain this to you by using an example. For example, we directly just look at the questions we take from the question bank, which I explained to you in the lecture. Now you guys see here what was happening in this question. I will tell you quickly. Let's understand this topic from this example about the embedded derivative, which is an important part. Entity is a company with currency of rupees, means it's an Indian company. This is a rupees 10 lakh contract to sell inventory equipment for them. I am making a contract for normal sales of goods. I am making the contract on June 30th and I am going to sell it on January 1st. Today I am contracting that after 6 months I will sell at $10 lakh worth of equipment, which is part of my inventory. To whom? To entity B. What is its currency? Rupees. So what is happening? One is entity A and the other one is B. What I am going to sell to B? I am going to sell normal goods for how much? For $10 lakh. So I am selling goods for $10 lakh. I am selling normal goods to Mr. B for $10 lakh after 6 months. So after 6 months I will get the money in dollars from Mr. B. Now think here, I am a rupees person. Rupees runs in my place. Rupees also runs in Mr. B's place. So why we made a contract in dollars? If B, let's say, was an American, it would make sense. It's a normal contract. It's possible he might said, I will only pay in dollar, make the bill for me in dollar. So a normal transaction in the market, it happens like this. It's a closely related matter. So what is happening here is I have a normal sale of goods transaction and it has flavor of foreign currency. So this is an embedded derivative, but it's not closely related. Why? Entity A and entity B both are from India, but still they are doing transactions in dollars. This generally doesn't happen. It is a strange thing. I am also from India and other party is also Indian, but transaction is happening in dollars. So that means you added this derivative to this. It is not closely related, not closely related. That generally does not happen. So this needs to be separate. So separate the transaction of the sale of goods and separate the derivative component. Separate the derivative and sale of goods component. You have to separate them. We will do accounting on sale of goods according to IND AS 115, and for derivative component we will do derivative accounting. So you understand that when it is a note closely related, I told you that. Now see the next point. Here, why did you make the contract in dollars? Sir, we did it because we are trying to take advantage of the price of dollar. I know what entity A must be thinking here. Entity A has sold goods and they will get dollars. I will think after 6 months I will get the money, right? Because we sold to the entity, the price of dollars might increase in the market after 6 months. So I will take advantage of that. And what entity B must have thought, that 6 months later the price of the dollar would be going down. He must have thought this. I can get dollar at lower price for less rupees in the market and I will give you the same amount in dollars. So both of them must have made the contract thinking about their own advantage. The advantage ultimately will be given to one at last. See now how it happens at 0 time, such a contract. For once I agree, if entity B was an American person, for once I agree in this case, what would have happened then? I sell a product. Okay, let's see. I sell a product, suppose for 5 crore 50 lakhs. I sell a product generally for 5 crore 50 lakhs, generally one product, I sell it in the market. This is my equipment inventory. Generally in India, I sell it to anyone for 5 crore 50 lakhs rupees, I assumed for once. One day I received a call from a person from America who said, I need this product. Tell me for how much you will sell it. I said 5 crore and 50 lakhs rupees. He said, sir, I am an American. I don't understand rupees. Tell me how much money will you take in dollars. So how do I tell him the money in dollar terms? You might be wondering what the dollar rate is today. Well, today, January 1st, the dollar is trading at 45 rupees. $1 equals to 45 rupees. So 55 lakh at the rate of 45 converted. So 55 lakh divided by 45. It's coming 22, 122, $222, something 122, $222, something is coming. Okay, whatever amount is coming. 122, $222, something is coming. Should I tell him this amount? Sir, I won't tell him this amount. Then sir, how can I tell him this amount? Think logically. I need 5 crore 50 lakh rupees. If I sell it to anyone in India, they will give me 5 crore 50 lakh. But the person in America is agreed to give me dollar. He is ready to give me dollars. How much amount do I need in dollars? I need that much, which is equal to 5 crore 50 lakhs. So that's all I converted at this rate. But sir, tell me, will I get this money today? Whatever you convert to dollars and tell him, will he get it today? No, he will not get it today. He will sell it after 6 months on 30th June, then he will get it. So today I will predict what the market rate will be on June 30th. I will predict what the market rate will be on June 30th. Where will I get the prediction rate? When you will go to the market, to the dealer, to the bank who deal in foreign currency. They give a forward rate for any day. So I will check their forward rate. What is current forward rate for 30th June today? See, the bank has quoted this forward rate on 1st January for 30th June. 6 months forward rate on 1st January. It means 30th of June. For the 30th of June, the bank has set a forward rate of $1 equals to 55 rupees. What does it mean? I wonder if the bank is willing to contract for 55 rupees for June 30th. So if I sell him the dollar today, the bank is ready to pay 55 rupees in 6 months and is ready to contract at this rate. Means the bank expert, somewhere he feels that the rate will be around 55 on that day. That is why he is ready to contract at the rate of 55. So that means I will tell the amount to the customer. I will say 55 rupees rate when I will talk to him. Understood this point? I divided this amount by 55. What did I get? One second. This amount is 5 crore 50 lakhs, right? If I divide this, it will come 10 lakh dollar. Okay, it's 10 lakh dollar. That means I will tell the other person 10 lakh dollar. Are you getting this? I will say pay 10 lakh dollar. We will sell it to you on 30th June. I said 10 lakh because I feel that the price will be 55 rupees on 30th June. So according to 55, if we convert it, then 5 crore 50 lakh, this much I will collect normally from these people. So how did they decided on a price of 10 lakh dollars? I am trying to explain that to you. Understand that much? Have you made any forward contract with bank? Actually not done any derivatives with bank. One has to be careful in embedded derivatives. Actually no contract forward future option is done. You can read the question. You will not find anything that says you have entered into any forward contract. I just go to the bank, I look at the menu card and then use the rates for my own calculations later. I thought this rate would be, so accordingly I told them, so accordingly I told the other person 10 lakh dollar. Okay, I told how this amount came. If not closely related, then account for the sale and derivatives separately. Now tell me the accounting for the sale as per IND AS 115. Okay, what will IND AS 115 tell accounting? According to 115, the sale will be accounted for. 115, what does it say? The day you transfer control, record the revenue. On the 1st of January, the day I signed the contract, is there anything need to do? We will not pass any entry of the sale because we will transfer the control on the 30th of June. So on that day, sale accounting will be done. On the 30th June, you will pass the sale entry. What entry will you pass to sale? In the debit, we will do debtor. We will get the money on 30th June. Debtor to sale, what amount will we do? Sir, what will be the final amount? This is the most important that you need to know. This is 10 lakh dollar. Our books are made in rupees. We are Indian people entity. This is from India. So it will need to be pass entry in rupees on what amount? For the embedded derivative case, I have explained the logic to think. How did I explain the amount of 10 lakh dollar? I am generally selling my product at 5 crore 50 lakhs, the normally in the market. So this amount I must have mentioned after deciding that what would be the forward rate on 30th June. What is the market rate on 30th June? What is the forward rate for 30th June today? What is the forward rate for 30th June in the market? I must have converted it and told. So converted from this, that's your actual sales value. You should book the sale at that price, which is 5 crore 50 lakh. We will book the sale at this price. The sale accounting is done. It's a simple accounting which will done on 30th June. Now we will do the accounting of derivative part. For the accounting of the derivative part, you need to apply the same derivative contract accounting. What will happen on the initial date? If the fair value is 0, then no entry will pass. After that, every balance sheet date, derivative needs to be shown at fair value. So 31st March will be one balance sheet date. It was shown at fair value on 31st March, but actually here no derivative contract was entered. Did I make any forward contract? No, neither future nor option. Keep this in mind. Then you will understand this topic. Actually, no forward contract, nothing was made. We are not doing any hedging or anything. We just want to take advantage of the price here. That is why we are intentionally entering into a foreign currency transaction. Therefore, how do we calculate the fair value of 31st March? Check the spot rate of the dollar and compare with it. This rate is of no use. Now you have to think that how do we compare it? We are trying to take advantage of the 30th June rate. What I should think that on 30th June, the dollar rate should just increase, according to which rate I would have decided the price 55. What was the rate for 30th June on 1st January? What was the rate available for 30th June in the market? The price must have been decided as per that expectations. So if the price in the market goes beyond 55 on 30th June, if the price increases above 55 on 30th June, then I will get benefit, right? The more it increases, the more money I will get in rupees. Therefore, I just want the price to increase. Now check on 31st March, what is the forward rate for 30th June? We need to keep comparing the forward rate till you get fair value. Check forward rate for 30th June on 31st March. The forward rate of March 31st, 3 months forward, which means 30th June's forward rate is 45. Now what? I skipped it on 31st March while today is 31st March. Later on, I went to the bank and I got to know that what was the forward rate for 30th June. Bank has written 45 rupees on the board outside. Hence, this means that according to the bank, the rate might be 45 rupees on 30th June. Now I am in shock. I told him that the price would be 55, but on 30th of June, the market price will be 45. Therefore, the price is going to drop. The dollar value will fall in the market on 30th June. I haven't actually made any derivative. 10 lakh dollars will come on 30th June, and now I think it will convert from 45. I was thinking that it will be converted from 55 and I sustained loss. If I incurred loss of 10 rupees in $1, then in 10 lakh dollar, there will be a loss of 1 crore rupees. How much did I lose on 10 lakh dollars? Around 1 crore rupees loss could be seen on it. This might happen as it's potentially unfavorable. I will do P&L to DFL. How much amount have I recorded before? I will record this directly. I will directly record. I can also show the solution from the journal entry. See, on 31st March at P&L to DFL, I suffered a loss of 1 crore rupees. This might be the estimate which I am seeing. It's possible, guys. Okay, did you understand that? We will do P&L to DFL. How 1 crore can be seen here? However, I thought it would have converted to 55 because that day the rate was 55. Although according to the bank's estimate, the price was 45 for 30th June and my money will be converted from 45. Hence, I will suffer 10 rupees loss. What mistake do we commit here? We think that we have done forward contract and we use our brain in 4x speed. We have made contract in 55 and the rate is 45 and we gained profit. There is no profit because we have no contract. We have not done any contract. We are just thinking about it to get a benefit. What will happen on 30th June? Our final settlement will be done on 30th June. The final settlement will be on June 30th. How will the final settlement happen? Now you have created this DFL on June 30th. Now see here. We will bring this at fair value. Now 30th June, what will be the spot rate on 30th June? 60. Today is June 30th. The market rate for a dollar is 60 rupees. If I get 10 lakh dollar, they will be converted from 60 because I didn't do any future forward. So it will be converted from 60. Now I thought at 0 time it will convert to 55. What will it be? Converted from 55. Now actually they will convert from 60. So I got 5 rupees benefit. What amount? Amount of 5 rupees benefit. It is favorable at 5 rupees on 10 lakh dollar. That is 5 rupees favorable on 50 lakh rupees. That means as of today, DFA's fair value is 50 lakh. What is 50 lakh? It is the DFA's fair value as of 30th June. Thus, I should have DFA of 50 lakhs today in my books, but I have already booked DFL of 1 crore in my books. We don't need DFL. We have to end it. What I will do on 30th June, I will finish DFL by doing the debit of 1 crore. Liability ends with debit. The DFA should be 50 lakhs, so I will book the DFA for 50 lakhs. Rest difference in P&L, the fair value gain loss goes from P&L only. 1.5 crore we have passed this settlement entry. Booked a DFA of 50 lakh, finished a DFL of 1 crore and 2 P&L. Now on 30th June, whatever the balance will be there in DFA and DFL added to the respective debtors on creditors account. We had a sale contract, a debtor is created, add in that account. We got balance of DFA in books. DFL is over. Today DFA came on maturity with amount of 50 lakhs. Shifted to the debtors account. So pass the entry we have to do to DFA 50 lakhs. To debit in debtor for 50 lakhs. This is according to your derivative. The embedded derivative is very simple. Normal non-financial item and derivative part will have a separate accounting which is done. Okay, it's normal, it's exactly the same. Just keep this in mind. You have to compare the forward date. According to that, you have to see. Is it clear? Why it was shifted to the debtors account? If it would be creditor, we would have purchased contract and shifted to creditors account. It has a logic. Look, I am doing sale on the 30th of June. How much? For 5 crore 50 lakh. How did that amount come? This $10 lakh. The rate of 55 which we imagined after 6 months was converted from this for the sale. But should the debtor also be at the same price of sale? Actually, we will get $10 lakh from the debtor when on 30th June it will be converted at this rate. So on 30th June it should come to $10 lakh multiplied by 60, that is 6 crores. But I have made the debtors entry at 5.5 crores. That means the benefit of DFA or DFL where it will go to the debtors account. The debtor has increased here because 50 lakhs have been transferred here. How much will be 5 crore 50 lakhs plus 50 lakhs? 6 crore. So if you want, you can pass the entry of sale on 30th June. This entry of sale and entry which we are passing, we can pass a single entry of both. You have booked the debtor at price of 60, which means 6 crores, right? You need to book the sale of 5.5 crore and the rest of your DFA, DFL balance should be coming. DFA, how much is it? 2 DFA. 50 lakh. Entry is matched. Means this entry and this entry can be single. Here I have just told you in the revision. In the end, we have done a complete proper solution for this. I will show you that also for a reference. Okay, so I will show you the solution for the class once again so that you remember it and understand the topic again. One second. You see this one, this was your solution. What accounting has entity done? Host contract sales of goods. No entry at 0 time. Debtor to sales on 30 June, 5 crore 50 lakh. And the derivative one, there is no entry on 1st January. On 31st March, we found out the fair value. According to that, general entry was passed P&L to DFL for 1 crore. That seemed potentially unfavorable. The DFA of 50 lakh was supposed to come on 30th June. We booked it after completing DFL. Last entry we passed was debtor to DFA. Then this DFA was transferred to the debtor account. And I put both of them in your bracket. I had told you that if you want both these entries, then a single entry can be passed instead of this. Okay, so this was your solution. It is a very small question. If you have studied the embedded derivatives properly, then you can solve it in 5-10 minutes. So just note and read it. If you are doing purchase or sale of goods or PP in any foreign currency, it will be host contract to purchase or sell good or PP. It's non-financial item embedded derivative contract in foreign currency. They will not be closely related. If the transaction is in a currency that is foreign to both parties who entered into the contract, if they are not closely related, how will the accounting be done? How will you record host contract, any purchases, sale of goods, PP, etc.? The purchase sale of goods, the delivery date or the purchase sale date or delivery date, I have put an oblique mark and written all three. As per respective IND AS, how much amount is it equivalent to company's currency using currency forward rate of delivery date on contract date? It was recorded as per the 30th June's contract rate, and that's what written. I have already noted its general entry. Normally there should be no problem. Embedded derivative accounting you will do. Derivative contract same. On initial date no entry will be passed. We will book DFA, DFL at fair value each balance sheet date. How will we do that? You compare currency forward rate of delivery date. Let's compare the currency forward rate for the delivery date. What was it at 0 time and what was the balance sheet date? Based on that, you were comparing and recording. After this, we record the fair value gain or loss on the settlement and delivery date. In the DFA, we did is on the DFL as well. And finally, the DFL DFA balance, whether it is debit or credit, will be generated on the delivery date. You will transfer it then. Let's move on to the next topic now. It's just regular purchases of financial assets. Take a quick look at it. There's no real use for it. What is this? Suppose that I have purchased a financial asset in the stock market. Which financial asset should I purchase? I am investing in equity shares. I am purchasing Reliance shares. It's a financial asset for me. How should we do the accounting for it? Though we have learned the financial asset, but we have to learn another specific point through this topic. What is that? See, sometimes what happens is that you purchase a financial asset, you purchase it today, but its settlement happens later in the future due to some regulation of the market. What is it? Stock market is just an example for which this topic is made. You purchase Reliance stock today in the stock market. You have seen the price, it's 2000. You have put in the purchase contract. So today's date is called trade date. But today this share will not reflect in your demat account. Let's go to the stock market's T+2 settlement. It will be settled in your account in 2 days. The shares will come into the demat and may be deducted from your bank on the same day. Money could be deducted from the bank as per its policy, right guys? But when does the financial asset arrive? It settles on T+2. So in such cases, how would we do the accounting? The trade date is today, but the settlement will be 2 days later because of a fixed regulation. This is because of fixed regulation. It's not a derivative contract just because of market regulations, because all were bought at today's price, but it just comes to my account after 2 days. So in this case, one thing comes up, the situation we have, that should we record this financial asset today on the trade date or on the settlement date? Trade dates give both approaches. You can record on the trade date or you can directly record on the settlement date. Understood? So the first approach is trade date accounting. What is trade date accounting? What does it say? It means you record it at fair value in your books on the trade date itself. So we record at fair value no matter what method is used, whether it's ACM, FVTOCI or FVTPL. Whatever will be the fair value on trade date, we will debit the financial asset from it and your payables will be ready if you have not paid it yet. What will be the amount for to payables? If I have purchased a share of Reliance worth 2000. So today I placed the contract and the price is 2000. My bank will only deduct 2000 later, even if after 2 days the value changes, the amount will be the same. Hence, what will you do on the settlement day? You will do the account for your financial assets through FVTPL. I hope you are getting this. It means that FVTOCI or FVTPL needs to be shown at fair value. You need to show this on the settlement date. When will the settlement date arrive? It came after 2 days. Now imagine I bought a share of 2000 rupees as financial asset to payable and did the accounting for 2000 on trade date. On the settlement date, this share price reached 2100 in the market. Now tell me what accounting I will do on the settlement day in ACM. I will not leave any financial assets. I will just pay the payables and finish it. Payables to cash or bank, how much? 2000 I had placed purchase contract for 2000 only. Don't say that on the settlement day as per that day you will pay. It doesn't work that way. I placed a purchase order just now, so it will be deducted at the current price. After this, if it is showing on FVTOCI or FVTPL, value of financial asset will also change. Payables to cash will be 2000. Only that entry will remain same. So what would be the financial asset? It would come on fair value, which is 2100. In the books it's shown 2000, means the financial asset will increase by 100. The difference in OCI will go into OCI. The difference in FVTPL will go to PNL. It's of no use. If you follow settlement date accounting, then don't do anything on the trade date. Directly pass the accounting entry on the settlement date. If you follow ACM, the entry on the settlement date would be financial asset to bank. The payment will be done directly. At what amount will the financial asset come in? The fair value on the trade date is its initial fair value. So it has to be recorded on that, and to bank payment will go which you contracted. If it is FVTOCI, then financial asset will come at the fair value on settlement date. To banks, the trade date amount will go, the difference in the entry will go in fair value gain loss in the OCI. If FVTP is there, then it's financial asset to bank. Financial asset will come on the day of settlement date and the bank will be paid through fair value trade date, while the difference of entry will go into the fair value gain of PNL. So if I say what is settlement date accounting, so in trade date accounting, trade date or settlement date, the entry you pass on these two dates, if you combine them and make single entry, then the accounting of settlement date will be done. There was one question of it which we have already done. Just look at the last topic. From an exam perspective, it's totally irrelevant. There is no chance of getting this in the exam. It will give free marks. Reclassification of financial assets. One more thing, regular purchases of financial assets. You might be thinking, is there no such topic for financial liability? So how can it be for financial liability? So if you are investing in equity shares of a company, then it is settled in T+2 in the stock market. This topic is made for that. If you raise money from liabilities, there is nothing about it. Okay, there is no topic in IND AS. So let's see the topic of reclassification of financial assets now. What does it mean to reclassify financial assets? Right now, let's say in the financial asset, I am showing it on ACM because my intention will be to hold till maturity. But in the future, my intention changes that I will sell this financial asset in some time after holding it for some time and then sell, means it will come in FVTOCI category. You will have to reclassify in FVTOCI. If intent changes and becomes FVTPL, then we'll have to show it in FVTPL. So if the intention changes, you have to reclassify the method of financial assets. So this topic is also not for financial liabilities because it come only on the ACM. There are two liabilities that come on the FVTPL which are fixed. So reclassification will never happen in this case. So in financial assets, it's a game of intention. So if the intention changes, you may need to reclassify accordingly. Understand how reclassification will be. In the first column, I added from ACM, from FVTPL or from FVTOCI. Next, in the first row, you can see 2 ACM, 2 FVTOCI or 2 FVTPL. So first, if it goes from ACM to ACM, will it go from ACM to ACM? Will there ever be a shift from ACM to ACM? No, it is same method. So we will shift from ACM to FVTOCI. In that case, what do you have to do? Show the fair value of the financial asset on the day you reclassify it. What will be the difference in entry? It will finish all your old ACM financial statement by doing credit. When you will book your new financial asset of FVTOCI at fair value for today, then it will be 1 lakh and will go in OCI. I hope you are following. If you are transferring from FVTPL, from ACM to FVTPL, then ACM to FVTPL, so in that case, the same reclassification date fair value will be applied to your financial asset. The difference in entry fair value gain loss will go in P&L. Next, if you convert from FVTPL to ACM value, then you will show the same fair value on the reclassification date and the difference in the fair value gain loss period. If you take FVTPL from FVTOCI, you will show the same fair value on reclassification date. Difference in entry will go in fair value gain loss in P&L. The logic here is that now you were following P&L, FVTPL, and the loss should be go in P&L. That's why today's gain loss will also go into P&L in this case. Moreover, see the last scenario. From FVTOCI to ACM, from FVTOCI to ACM, it will be to ACM. In this scenario, what will you do? The original amount that was the financial asset at 0 time, we show it, means whatever your carrying amount in books is coming in FVTOCI today, reclassify it on the financial asset. And in addition, due to FVTOCI, fair value reserve created in the OCI, fair value gain and loss, reverse that entire amount in the financial asset so that the financial assets is displayed as original amount in the ACM. That's it. Now you have to see from FVTOCI to FVTPL, and here you have to show fair value at the reclassification date because both refer to fair value. On fair value, we need to show on reclassification date whatever fair value gain or loss there, you have to take it to P&L. Beside this, any balance of fair value reserve in OCI, including fair value gain or loss, should be transferred to P&L from OCI. Because today we will derecognize the OCI asset which is fair value through OCI and will book new FVTPL. I told you, whenever we remove the FVTOCI from the books, rest gain or loss that on OCI will be reclassified to P&L. So whatever is related to OCI will be put in P&L today, and today's gain loss will be shown at fair value. So it will also go in P&L. I told you the provision of transferring from FVTPL to FVTOCI. So just keep this table in your mind. With this, the topic is completed, and I have revised the entire chapter for you. It's a very easy chapter. Just follow the way I explained. We have already done all the questions in detail. We solved them. So you have to practice those questions. Those who are just listening to revision videos on YouTube, after revising from these notes through this video, then you should solve my question bank completely at your own pace, and then you will be able to easily complete this chapter. Very easily you can get 15 out of 20 marks in this chapter. 15 to 16 marks are achievable. It is very easy. Follow what I told you. Follow those steps. Nothing will go wrong. Okay. It takes a little time to do these questions in this chapter because of PV and other stuff. Other than there is no problem. If you still have any problem, you can message me anytime. It's not just for students in class. If you are watching on YouTube, you can also message me. It's not a problem. I'll answer any doubts. I'll resolve them for you. And how was the lecture? Please share your review and also share your response with me. Tell me what you thought. And if you like it, then you can also share it with your friends. So that's all for today. Thank you so much.